go through
And
the
furthermore,
last
if you
question
want
of
to
the
install hard
sample
drives
exam,
and you
which is
have a
question number
pretty
7,
reasonable sized power
just for
supply,
you to
you pretty much
see a
know how to
different type
install your
of
modular
exercise.
cable.
We have this information on the budget for next quarter. Remember, a quarter is 3 months. So we have here the cash at the beginning of the budgeting period, the cash at the end of the budgeting period. So cash information, we can find it in a financial statement. Which financial statement can we find this information? Who can let me know? The financial statement, where we find this information, the balance
statement of cash flows.
We can also have it in the cash flow statement, but the balance sheet, this is information that we also have from the balance sheet, and that information comes also from the statement of cash flows. Good. Then we have sales during the period. Sales information, do we get it also from the balance sheet?
Income statement.
The income statement, very good. So we have here information both from balance sheet and from the income statement. Then we have receipts from sales during the budgeting period. Receipts from sales, where do we get this information from? This is how much money clients paid or we expect to pay during the budgeting period. Good.
Cash flow statement.
Cash flow statement, very good. Then sales collection period is 1 month. That is the policy, the payment policy of the organization. We have purchases during the period. We have payments from purchases. So purchases, we also have it. We also have this information in which statement? Purchase, for instance, of materials. Or if we are a merchandising company, purchase of the products that we resell. Cash flow statement, great. Payments from purchases, we have, no, purchases we don't have from the cash flow. The payments from purchases we get from the cash flow. The purchases we get on the income statement, very good. Then we have the purchase payment period, which is 15 days, that is half the month. And then we have payments of other costs, like electricity, water, rent, etc. So this information we have, and this information, it comes from different parts, different expected or different parts of the budget. So you remember we have the master budget. The master budget brings together the different operational budgets. So we have the sales budget, we have the production budget, we have the inventories budget, we have the expenses budget, we have the various budgets, and then they come together in the budgeted statements. And that is the budgeted cash flow statement, the budgeted income statement, and the budgeted balance sheet. And here we have information from these 3 statements and also from the payments policy of the organization. One assumption that we make in this kind of exercises is that it is homogeneous activity. So for instance, this information is for the quarter, and that is 3 months. So for instance, if we have the sales during the budgeting period of 60,000, it means if this 60,000 is for 3 months, we are assuming that in each month they sell 20,000. 20 plus 20 plus 20, okay? So that is this one of the assumptions that we make. And we also make the assumption that every month is 30 days, okay? So 1 month is 30 days, 15 days is half a month, okay? So this is assumptions that we have. And then on the exercise, they are asking us, so you can open the exam there on Moodle, and they are asking us information on, let me open. So first question is the value of receivables at the beginning of the budgeting period. So basically they want us to calculate on this exam question the value of receivables at the beginning and at the end of the budgeting period, and also the value of payables to suppliers at the beginning and at the end of the budgeting period. So for this, we need to understand the information that is provided and also the mechanics of the financial statements, which I expect everyone to be comfortable with because you had financial accounting before. So for us to identify the amount of receivables from clients at the beginning of the period, how can we go about to get this information? So which information that we have available that is relevant to get the value of receivables at the beginning and at the end of the period? Who can participate?
The sales during the period, the receipts
Mhm.
from sales in the sales collection period.
Okay, very good. So we have sales during the period, 60,000. It says that we have receipts during the budgeting period. So this is all expected information. So this is budget is expected, what we expect to happen. So we expect to sell 60,000 worth of products. We expect to receive 58,000, and there is a sales collection period of 1 month. Now we need to understand these receipts of 58,000. So these receipts of 58,000 during the budgeting period, which is 3 months, should include what? What is there in those 58,000? Or what should be there?
The value of the receivables and from last period and 2 months of the sales of this period.
And then the remaining month, so the last month of the quarter, should be receivables at the end of the period. Yeah, is everyone following? So during the period, we expect to sell 60,000 and we expect to receive 58,000. The 58,000 that we expect to receive will be first how much the clients were owing the company at the beginning of the period. That is the value of receivables, okay, at the beginning of the period. Plus the quarter is 3 months, plus the first month, which you will receive in the second month of the period, and the second month of sales, which you will receive in the third month of the budgeting period. The last month of sales we will receive in the following month after the budgeting period, because we have a sales collection period of 1 month. So if we have 3 quarters, the first quarter of sales we will receive in the second quarter. The second quarter of sales we will receive in the third quarter, and the third quarter we will receive in the third month. In the second month, first month of sales we will receive in the second month. Second month of sales we will receive in the third month of the quarter, and the third month of sales we will receive in the following month, which is second quarter. Okay. So we always have this 1 month delay. So in the first month, we will receive the amount that we had in receivables. So if we are going to receive 2 months of sales, and if we have 3 months is 60,000, that means that per month we have sales of 20,000. If we receive 2 months is 40,000. That means that we had receivables at the beginning of the period of how much?
18,000.
18,000. Okay, so I will type here in the chat. So we have sales of 3 months equal to 60,000. That means that 1 month sales is 20,000. We receive 2 months of sales, which is equal to 40,000. We will also receive the amount of receivables at the beginning of the period. And that will be the difference between the 58,000 minus the 40,000, which is 18,000. Is everyone following? Any questions?
Can you please just explain again what are those receipts from sales, please?
The receipts from sales, the 58,000, is the amount that the company expects to receive, the cash it expects to receive from clients during the 3 months. Okay, and these 3 months, during the 3 months, they will receive the amount that the clients were owing the company at the beginning of the period, which is the receivables at the beginning of the period, and will receive the sales that they made during the period. Because there is a sales collection period of 1 month, it means that they will receive only 2 months, because the last month of sales, they will only receive the following month, okay, which is outside of this quarter. Okay,
so basically the 18,000, it's like receivables from the period before.
Exactly.
Okay.
Exactly. Very good. More questions? Now everyone's good with this? Yep. So who can tell me? So I have here a comment from Frederick. Let me read. Sales equals to revenues and receipts equal to cash flow. Yep. So when we talk about sales, it's the sales revenues that we have in the income statement. And when we talk about receipts, is about the cash flow that we find in the cash flow statement. Very good. Now, who can tell me how much is the amount of receivables at the end of the period? At the end of the period is 20,000. Very good, Frederick. So at the end of the period, what the clients are owing the company is the 20,000 of sales from the last month of the quarter. Very good. Now, the next question, so question number 3. Any question before we go to question number 3?
Sorry, can you explain again the 18,000 of the difference?
Yeah. So the 58,000 that we have there, which is the amount that the company expects to receive, the cash it expects to receive from clients, will include the amount that the clients were owing at the beginning of the period, plus the sales that they will receive. The clients will pay for those sales of the period. Okay. And because we have a sales collection period of 1 month, and we are doing this for the quarter, and the quarter is 3 months, it means that the last month of sales, the last month of the quarter, we will only receive afterwards, okay? In the next quarter, in the following quarter. So it means that from the sales of the period, we will receive only 2 months. The sales, let's imagine the quarter is January, February, and March. The sales from January we will receive in February. The sales from February we will receive in March. And the sales from March we will receive in April. But April's already a different quarter. So we will receive only 2 months from the sales that we make during the budgeting period. That is, if it is 60,000 for 3 months, it is 20,000 per month. So if you will receive 2 months is 40,000, okay? But the company will also receive how much the clients were owing from the previous quarter. So the sales from December, okay? So the sales from December that the clients were owing the company, at the beginning of the period, they are registered in the balance sheet as accounts receivables. These accounts receivables, they will receive in January. and they are the sales done in December. Okay. How we want to know, the first question is, how much is this amount of receivables? We only have information of the sales during the period. We saw that they will receive 40,000 during the month, but as we also have information that they expect to receive 58,000, that means that the amount that they had at the beginning was the difference between 58,000 and 40,000, the 18,000 euros. Does it make sense?
Yes, thank you.
Yep. More questions before we move on to the following question on payables? No? So the following question is asking about the amount of payables to suppliers at the beginning of the period and then at the end of the period. So it's the same rationale, but as receivables is the amount that the company expects to receive, the cash inflow, payables is cash outflow, the amount that the company expects to pay. Payables at the beginning of the period is how much the company is owing to suppliers at the beginning of the period, so January 1st. And we have the company will pay to suppliers from purchases, okay? So this is payables in relation to purchases. Let's imagine it's direct materials. So we have their purchases during the period. We have payments from purchases during the period, and we have the purchases payment period, okay? So this is the relevant information we want to look at to calculate the amount of payables at the beginning and the amount of payables at the end of the period. So who can tell me how much or how we can calculate the amount of payables at the beginning of the period?
So following the same rationale as before, we have that we will purchase 3,000, but in this case it's divided by 6 because it's 2 weeks, the period of payments, right? So we basically have 55,500 per week,
5,500
per 2 weeks, exactly. And so we have to basically assume that one of those 2 week payments will be in the end of the period, right?
Okay, so we already know how much will be the amount of payables at the end of the period, right? That's what you're saying.
Yeah.
Okay, so at the end of the period, the amount of payables is
5,500.
very good. That is the last 15 days of purchases. So the company expects to have 33,000 of purchases during the 3 months. That means per month is 11,000, and the last half month, so half 11,000 is 5,500 euros. They will be owing the suppliers at the end of the period. Very good. But the question was
the beginning.
Beginning.
Exactly. So we know that the payments that the payments from purchases will be 41,500,000, and so if we subtract the 27,500 that was left from the calculations before, basically we get to 14,000 of payments that should be in the beginning.
Very good. So if we expect to pay 2.5 months, 2.5 months would be 27,500. 27,500. we will be owing the company at the end of the period 5,500. The difference between 41,500 and the 27,500 is 14,000, and that is how much we were owing the suppliers at the beginning of the period. Very good, thank you very much. Also, Frederick also posted there. Thank you very much, Frederick, for sharing that on the chat.
Professor, yep. Can you just write the answers, because it's really hard to follow the rationale just by talking. Can you write on the chat or in the board like last week?
Yeah, I'm going to use the board, but the board is already half filled in. You cannot see now, but you will see in a few minutes. It's already half filled in. That's why I'm not using the board. But we will write here in the chat. So we will have purchases of 33,000 for 3 months. That is equal, that means that we have 11,000 per month. We will owe the suppliers half month, which is 15 days. And that is 5,500 euros. That means that we will pay the suppliers for purchases made during the month equal to 27,500, and this is equal to 33,000 minus the 5,500 that we will owe the suppliers. Okay? To calculate the payables at the beginning, we calculate that 41,500 minus the 27,500, which is 14,000. Okay. Questions on this? So there can be a lot of variants on these type of exercises. So you have other variants on these type of exercises on the example quiz that you have there, optional activities from last week on budgeting. And also the homework will have some variant of this type of exercises. What you need to be comfortable with, to understand the rationale. Okay, so this rationale on how much we pay in terms of the payment period, okay, and the collection period. So is 1 month, is 15 days, is 2 months. The assumption is always that we have an homogeneous level of activity. So if it is information is for the quarter, we assume that every month of the quarter will sell the same quantity. We know that in reality, these might be different, and it depends a lot on business to business. These type of questions can also ask, what is the amount of cash at the end of the period given this and this information? Here we already had the amount of cash at the end of the period, but we could calculate, okay? Yeah. They could ask about how much is the receipts, and if they had given you information on the opening inventory of payables and receivables, they could ask about how much is the value of receipts, how much is the value of payments. They can ask about inventory, production, okay? So for instance, they can provide information on how much the company expects to sell, okay? And then they will tell you information, how much is the opening inventory of units at the beginning, and you needed to see how much the company needs to purchase or how much the company needs to produce in order to be able to sell, to have units enough to sell for the following period. Okay, so very often we see exercises that they say how much they have at the beginning of the period. They say that, you know, at the end of the period, they need to have a closing inventory, this percentage of next period. And we have to see how much the company needs to purchase or how much the company needs to produce. Okay, so this type of questions is important to have this understanding of the mechanics, and these mechanics comes from financial accounting. That's why we are not going very detailed on this. I'm just giving you more broader information, but then you have some exercises like this one to be able to practice. Any questions on this before we move on to variance analysis?
I got a quick question. On one of the questions from the quiz regarding budgeting, they talk about I think it's inventory merchandising balance or merchandising inventory balance. What is that? I think we haven't talked about it.
The inventory, so that is for a merchandising company like a supermarket. Okay, so the inventory of merchandise is the inventory of products that they have in the supermarket to sell. Okay, if it is the opening inventory, is at the beginning of the period, is if it is at the end of the closing inventory, is at the end of the period.
Okay, so when they say that it's the balance, it's like the end less the beginning inventory.
The balance, so you have to see the date of the exercise. So the balance is what they have on that date.
Okay.
Okay. More questions? No, everyone's ready for variance analysis? Yep. So let's go to variance analysis and standard cost. So we will first talk about standard costs, which is very important, and we have talked about that last week on standard cost, standard pricing. But today we will have the definition, and then we will talk about variance analysis. You can find more on this on chapter 11 from the book. So standard cost is a predetermined cost. Okay, so these are target costs that the company expects to incur if they have efficient operating conditions. Okay, standard cost is different from budgeted costs, and we have here the difference. So basically, when you talk about standard cost or standard price, is the expected, so it's kind of budget. Okay, it's for the future what they expect to be, but it's per unit. The difference between standard and budget cost is that standard is per unit and budget cost is the cost for the total activity. Okay, so we saw on the example that we made on the pink skirts last week, we had there the standard price that was per unit. Okay, and when we calculate the sales revenues for the total activity, that is a budgeted amount in total. Standard is per unit. Just this is the difference. Standard is important. To have this notion of standard, it seems a little bit redundant when we talk about standard and budgeted costs, but it's actually an important concept for organizations, because organizations will use this standard cost to set the price for the job. Okay, so it's kind of a benchmark that companies use to evaluate the costs that they will have. For instance, let's imagine that they receive a client, they produce canoes, and there is a client that wants to produce it, that wants to have this special canoe with special features. The company will think about standard cost. Okay, this special canoe will use this much materials. How much is the standard cost of per material, per kilogram of material? And the standard cost of labor. Okay, this canoe will take this many hours. So how much is the standard cost per hour of labor? Okay, this will help the organization to make a standard selling price, or what they expect to be the selling price, and give these to clients and say, okay, we can produce this special canoe for you, and this will cost this much. In order to provide this information to the client, the company needs to have this background information on standard costs of materials and labor and overheads. Okay? So this is very important, and obviously is important on the day-to-day activities when we have special orders, and obviously to prepare the budgets, okay, that the company do annually or on a rolling budget every month. So obviously we can have these standard costs for labor, materials, and manufacturing overheads. What do companies do with this information? They have the standard cost. With the standard cost, they prepare the budget, and then they will compare this with the actual costs that were incurred. So this is already part, what we have here on the slide is already part of the controlling step of planning and control. Okay, so we plan with the standard cost, and then we will compare with what were the actual costs, the real costs incurred during the period, after the period has passed, and we will compare and see if there are any variances. If there are any variances, we will investigate the reasons for the variances, and we will take corrective actions. Okay, and this might mean that we need to adjust standard costs for the future. Okay, let's, for instance, imagine that there was a change in the oil price, and we know the oil price is always changing. The company expected a standard cost of oil price, okay, and based on that standard cost, it prepared the budgets. And then there was a big change in this price of the oil, and then they can adjust for the future the standard cost of the price. We saw recently, I think it was last week on the news in Portugal, that a paper producing company, Navigator, if I'm not mistaken, is going to increase the selling price of napkins and other tissues that they sell. Was it Navigate? No, was it Renov? I think it was, I don't remember, I'm sorry for that. So one of the paper producing companies is going to increase the price, and then they explain why. They explain because there is a change in the standard, in the costs, and because of that they have to change the standard costs that they have in the production, and therefore they will increase the selling price. Marla, yes.
Could you maybe explain what is the exact difference between costs I get from ABC costing between this and standard costs?
Okay, so it is a different topic, okay? So when we talked about traditional costing system and activity-based costing system, the objective was to calculate, to allocate the cost of products or services. Okay, so that was the objective. So that, and we used different systems to allocate indirect costs to products. Okay, we could use traditional costing systems with single overhead rate, multiple overhead rates, homogeneous cost pool, and activity-based costing system. Now we are talking about, we have moved topic. We are now in topic number 4. In topic number 4, we are talking about information for planning and control. To plan and control the future activities, plan future activities, and then control how they perform according to plan. I understand this might be, the language is a little bit confusing because also here is costing system. But this is something that is not directly related with the costing systems we talked about when you talk about traditional and activity-based costing systems, okay? The standard costing system, it is just a way that companies use to prepare the budgets, okay? So when preparing the budgets, and we did this last week, when prepared the budget for these pink skirts, we had the standard cost of materials, we had the standard cost of labor, and that was how we prepared the budget. Use the standard costing system. which is basically information of the unit costs of the materials and labor and overheads, okay? And this is not directly related with traditional or activity-based costing system, okay? It just happens to be called also standard costing system, but we don't use it as a way to allocate indirect costs, okay? We use it to prepare the budgets, okay? Does this make sense?
Yes, thank you.
Okay, any more questions? No? So this standard costing is very important for organizations for these reasons I was explaining you, and you see this is really used in organizations on a day-to-day basis. So anytime companies, clients go and ask for special orders, they will use the standard costing in order to give a price to the clients, okay? And you see this a lot in furniture companies, in companies that do work for job, you know, the job costing system. We talked about before as well, the process costing and job costing. So for job costing, the companies will have orders from clients that are unique, and in order to give a pricing to clients, they will use this standard costing, which is expected costs per unit. Then they will compare these standard costs, which is what they expected to be, with what were the actual real costs, okay? They will identify if there are any variances. If there are variances, they will investigate why there were those variances, and they will if they needed, they will take corrective actions and make adjustments in the standard costs for the future. Very good. So what are the purposes of standard costs? So is to provide a prediction of future costs, which will be used for decision making. So if we have a client going there, you know, I want you to produce this special canoe and I will pay you this much. The company will decide if they will accept or not this special order. To provide a challenging target that individuals are motivated to achieve. Okay, so if we have a standard cost for direct materials, the purchases manager that is responsible to purchase the direct materials, he will have this standard cost and he will make the best effort to purchase the materials at this cost or below, okay? So they will search for the best suppliers, they will search, you know, they will try to negotiate for discounts in order to be on the standard cost or below the standard cost. They will also help us to evaluate performance of the organization as we use it to prepare the budgets, and then we will compare the budgets with what actually happened, and with these comparison we can evaluate the performance of the organization and of the different managers. It also acts as a control device, so the company can identify those activities that did not conform to what was expected. So the purchases manager managed to purchase the materials at the standard cost, but there was still something going wrong. So identify what went wrong, and it was not the purchase manager, it was direct labor. Direct labor was more expensive because they had to work extra hours, had to pay extra hours, which was more expensive. So we can identify what went according to plan and what did not go according to the plan, to the budget. And also it will simplify the part of that we can trace the costs for inventory valuation, okay? So obviously when we did the homogeneous cost pool, activity-based costing, we did that with actual costs. But as you know, we can only know actual costs after the period. If we want to calculate the cost of products before, and we talk about this, if you remember, about the budgeted overhead rate, and we had under recovery and over recovery of overheads. If we have the standard costs, we can allocate the expected costs to products. using either ABC or homogeneous cost pool or a single overhead rate, we can allocate the cost that we expect to happen. And then based on these, we can adjust when we know the actual cost, we can adjust with under or over recovery of overheads. But this is important so that to help companies to have information that is on time, okay? Because not always the company has all information on costs when they need the information. So if the client goes there to ask to do this special product or this special order, we don't know the costs before, we only know the costs afterwards. But we need to give a pricing before for the client to make the decision of purchasing or not purchasing that special order. Okay, so this is important for organizations to have this standard costing. Any questions before we move to the next slide? Anyone? No? Very good. So let's go to this example. So this is the same example that we had last week. So we have here that the company manufactures the pink skirts, and there is the standard price. You see that is the budgeted price per unit. The standard price is, they we expect to be £50. Each skirt requires 3 meters of material, which is bought at the budgeted price of £4 per meter. So this purchase price is a standard cost. So it's a cost of materials for the organization of £4 per meter. It takes 1.25 hours of direct labor to make one skirt. Direct workers are paid £10 per hour in proportion to the hours that they actually work. The company expects indirect salaries of £8,000 per month and all other overheads of £20,000 per month, including a depreciation of £6,000 per month, rent of £2,000 per month. The company is planning to sell 5,000 units in the 3 months of January to March. Okay, so this is all this information is to prepare the budget for 3 months, January, February, March. And we did the budget last week, you remember? So we did that budget, and I have that budget in the board, and I will show you that next. Then we have here the actual results for these 3 months. So it says that the company actually sold 6,000 units. They expected to sell 5,000. In reality, they sold 6,000. They sold it at £46 per unit. We expected to sell, if we go to the slides, £50 per unit, and they actually sold at 46. The company used 21,600 meters of material, which in total costed £97,200. Direct labor was paid in total £109,200, and that was an average of £14 per hour. We have indirect salary of 28,000, rent and depreciation were the same as the budget. However, the company had to spend additionally £20,000 on marketing and promotion. And they say that the other overheads were 24,000. They are asked to prepare the actual P&L for the company and to compare the actual results with the budgeted results. So that's what we are going to do. So I will stop sharing the screen. So make sure that you have this information. So you can download the slides from Moodle or just take a print screen. And I will stop sharing. So that you can see the board behind me. So you see here we have, this we did last week, okay? So we have here the budget. We have budgeted for 5,000 units. So that was expected sales of 250,000. Direct materials we expected to be £60,000. Direct labor we expected to be 62,500, which would give an expected contribution margin of 127,500. We expect indirect salaries 24,000, rent of 6,000, depreciation 18,000, and other overheads 36,000, an expected profit of 43,500. So this is the information that we expected on the budget. Okay, now they give us the actual information, what actually happened. And that is what we're going to do now. We are going to make the actual P&L for the period of January to March for this organization. So they say that the company sold 6,000 units. So you will do here the actual. And in the actual, they sold 6,000 units. They expected to sell 5,000. They actually sold 6,000. And they say that the expected price, the actual selling price was 46 pounds. So 46 pounds, I will write here 6,000 units times 46 pounds per unit would give us a sales revenues of 276,000 pounds. Okay, so that was the actual revenues. Actual selling price, 46 pounds times actual quantity, 6,000 units. Then we have information on direct materials. On direct materials, they say, let me open here the exercise. They say that the company used 21,600 meters of material, and that was 97,200 pounds. So we have the amount in pounds, 97,200 pounds, and we know that this was 21,000. It was 21,600 meters. That means that we can actually calculate the amount per meter. Okay, so we can calculate the cost per meter of material. So if we divide 97,200 by 21,600 meters, we know how many pounds per meter we get. That is very easy, so that gives us 4.5. This is relevant to calculate this standard cost, this unit cost. This is not standard. We will compare this with the standard cost later on. Okay, so this helps us to in the future to compare the actual cost per unit with the standard cost of materials. Very good. Any questions so far?
And they actually used more meters than the budget for each piece.
So it is two bad things together, right? They paid more expensive, and second, they used more meters, so they were less efficient than they were expecting. So this brings together two bad things. That's why it's much higher. 97,200 is much higher than the expected 60,000.
Professor,
point. Yeah.
They use more meters because they sell more, right? Or because they were less efficient.
Let's figure that out. How do we figure that out?
If we divide the whole meters by the unit value.
Okay, so the information, we go to the budget information. So we go to the budgeted information and says that each skirt requires 3 meters. So we can make I will just write here 3 meters times 6,000 units. How much would this mean? 3 meters times 6,000?
18,000.
So we are comparing the 18,000 with the 21,600. So they should have used 18,000 meters, and they actually used 21,600 meters. Okay, that's why we can say they were less efficient than expected. They actually used per unit We can divide 21,000.
It's 3.6.
by the 6,000 units. They actually used, instead of 3 meters per unit, they used 3.6 meters per unit. Okay, so the usage of materials was higher than what was expected.
Okay. Thank you, Professor.
Okay? But that is a very good point, and we will come back to that later. Okay, we will talk about this in more detail once we finish this part. So we have seen here in terms of labor, in terms of materials. Now in terms of labor, what do they say about labor? So they say that labor was paid 109,200 pounds. That was the actual cost, 109,200 pounds, and that it was average cost per hour of 14 pounds per hour. So that means 14 pounds per hour times these many hours was the total of 109,200. So how many hours they actually worked? We just divide 109,200 by the 14 per hour. How many hours did they work?
7,800.
7,800 hours, okay? And we can compare how much they expected to work. So they expected to take 1 hour and a quarter for each unit. So if we make 1.25 hours times the 6,000 units, how much would that give us?
7,500.
Sorry?
7,500 hours.
7,500. So they were, again, less efficient than expected, you see? So they should have used 7,500 if they were taking 1 hour and a quarter per unit, but they actually used 7,800 hours. And not only that, but they actually paid 14 pounds per hour when they expected to pay 10 pounds per hour. So again, two bad things together, here on labor as well as on materials. Very good. Any questions? No? So that means that they expected to, they actually had contribution margin of 69,600 euros when they expected the contribution margin to be 127,500. So much lower than they expected. Then we have information on the other costs. So what information do they have? So they say that the indirect salary was 28,000. Indirect salary 28,000 instead of 24. They say that rent and depreciation was the same as budget. So rent was 6,000 and depreciation was 18,000, same as expected. And then they said that the company had to spend additionally 20,000 in marketing and promotion, and all of the overheads were 24,000. So we have here 24,000 with the other overheads, plus 20,000 on promotion and marketing. So 20,000 plus 24,000 gives us 44,000. Okay, so we are putting them all together in the other overheads. This means that the company had not a profit, but a loss of 26,400 pounds. So we did the first part of the question, which was to prepare the actual P&L. The second part of the question asked us to compare the actual results loss of 26,400 with the expected results of a profit of 43,500. So let's compare this. What can you say about this? So, based on this, what can we say?
That the budget was very optimistic.
The budget was very optimistic, or something really, really, really bad happened that they could not predict. Okay, either it was very optimistic or there was huge crisis, and then that could justify what actually happened. And let's go line by line. So can you make up a story to explain what happened? Can you think about a story explaining what happened here in this organization? Let's think we have a sales manager. You remember we talk about responsibility centers. Let's think about we have a sales manager that is responsible for the sales revenues. We have a production manager. We have a human resources manager. We have, other costs managers. Let's think about responsibility centers. Who is responsible for what, and what could have happened here in this organization? Who wants to make up a story? Let's use a little bit of our imagination to make up a story explaining what could have happened.
Maybe just another company opened and they would compete with them, and so they had to raise their salaries and to lower their selling price in order to still sell their skirts.
Okay, so maybe there was a new competitor in the market, and the competitor was probably selling at a lower price that obliged them to lower the selling price from 50 to 46. Okay, and how does that explain in terms of materials and labor? Maybe the new company was paying employees more expensive. That could be, and the employees came together in the union and they fight for higher salaries, and then the direct labor per unit increased. Could be. Or due to the higher demand of materials because of the competitor was also purchasing materials from the suppliers. Higher demand increased the selling price of the materials in the market. So we have higher selling price of the materials, could be. Or if the competitor hired the employees from the company needed to hire new employees, and the new employees were more expensive than the previous ones. And because they were new, they didn't know very well the production process. That's why they were inefficient. Okay, that is a story that we can tell. Very good, thank you very much. Another story that we can tell about this company.
Maybe they are just bad managers.
Maybe they are bad managers. Can you explain?
So I think that the other example was explaining external factors, and this looks a lot. This for me is to have some internal responsibilities, and I don't know. I think that getting worse in every part of the direct costs. I think that could be the management fault.
It's a management fault. What could be the root cause of this poor management?
I don't know, but maybe we are producing outside of our efficient capacity.
Okay, what could lead the company to produce outside the efficient capacity?
The increase
Maybe
of quantity.
or they received a special order that
Mhm.
they shouldn't accept it, but they did, maybe.
Or think about
sorry, I was just saying, isn't it possible that we just have a poor how do you call it, the ABC, sorry, the cost systems, and we're not assessing how much our products should cost, and then that leads us to making a bad budget? Isn't it possible?
They had poor standards, okay? They had outdated standard costs, okay? That could also be a reason. But I want to explore further these options from Duarte and Gonçalo that they were mentioning. So let's imagine this, that we have this company. And in this company, we have the purchase manager, the sales manager. And the sales manager receives a bonus at the end of the period according to the sales revenues. And they expected to sell 5,000 units at 50 euros per unit. And he could make effort by lowering the selling price to 46 and sell 1,000 extra units. He will receive a bonus if he's receiving bonus based on the sales revenues, because sales revenues were higher than expected. You see? So the sales manager, just by himself, without communicating to the other managers, he could come up with, I just sell more, I sell a little bit cheaper per unit, but I sell more units and my sales revenues are higher. I will receive a bonus at the end of the year. And he does not think about the consequences of increasing the units sold. So these 6,000 can be outside of the efficient production. So normally, if they were expecting to produce 5,000, they had agreements with the suppliers of materials for the materials of 5,000. Now they had to search last minute for extra materials. So maybe that is a reason why the price per materials increased. Maybe they were not able to find the exact same materials, and the new materials that they find, they were of poor quality, justifying the increase of the usage of materials, the meters of materials used, because they were not the same materials as expected. And then also because they had to produce more units, they didn't have enough labor. They had to have extra hours, so employees to work long in the evenings or go to work on the weekends, and the company needed to pay extra for these extra hours. Or maybe they had to hire new employees last minute, and these were also more expensive. That can justify the increase in direct labor pounds per hour, and also can justify the inefficient of labor. If employees are working extra hours, they will be more tired, they will take longer to produce. Or if they are hiring new employees, the new employees, they don't know how to do the production process as well, they will be more inefficient than what was expected. Okay, so this could be a reason, a possible story, like the other stories that we discussed before, that could have happened, you see. And here, in this example, we are discussing a possible story that can happen. And if you see, it could happen if they didn't do the budget properly, and if they don't have a proper performance evaluation. You remember last week we discussed about the roles of the budget, and the budget can be used to coordinate activities, to communicate. And in this makeup story, that didn't happen, okay? And that led the production manager, human resources, to go last minute looking for things, okay? And that led to, in the end, a poor performance of the company as a whole. Okay.
I didn't understand. Sorry.
Yeah.
Sorry,
I
Madalena,
didn't
go ahead.
understand. Yeah,
So
thank you.
Madalena,
Yeah, I didn't understand what you said. So how could the sales manager by itself make all the company have to produce more? I didn't get it.
so let's imagine that the sales manager sells this quantity without communicating to the production manager. Obviously, this should not happen if the company has a good management control system. Okay, this should not happen, but it could happen in some cases. Okay, so the sales manager could sell more than expected, and then the production manager had to solve the problems. Okay, and to solve the problems, so to say, they needed to purchase materials more expensive and hire labor also more expensive. Does it make sense?
Yeah, thank you.
Philip?
Yeah, Professor, I have a question. For example, if this was an exam question, could we argue that the budget prediction that we made could be also correct if the manager followed the number of units that the budget predicted? Like the problem was not in the budget, was because the manager decided to produce more and don't stick up with the optimal capacity of the company, or not?
I'm not sure I follow.
Yeah, I know that the budget, the reason we do the budget is to predict what we are going to do. But the budget could be also correct if we follow the 5,000 units that the budget predicted that we should sell.
Sorry, I'm not understanding the
Okay,
question.
no problem. This was that this is not very important.
Let's try to understand. So when the company produced the budget, this was what they expected to happen. Let's imagine it was not even the sales manager that was behaving bad in this example that I gave, or in the previous examples that Marla gave, there was a competitor. So let's just imagine there was more demand. We can have, and it's very normal that we have, in terms of level of activity, different from the budgeted level of activity. Okay?
Yeah.
So that does not make the budget bad. Okay? It's just normal because we cannot predict the future 100%. Okay? Let's see. If we think about last year, the factories producing masks, they produce masks for normal use in hospitals. They did not predict that there was a huge demand in masks because of the pandemic. Okay, so there was a difference in the level of activity due to the circumstances, and they could not predict that. Okay. Now I did not understand what was your question.
Yeah, my point was the problem was not with the budget, but was with sell more units in order to get the bonus. So the budget predicted that the company should sell 50,000 units, and that's the optimal level to sell in this company. But the manager said, okay, I don't care about this. I want to sell more units because I would get a higher bonus. So the problem here, I could say it's bad management. And for example, the guys that did the budget they were related with the manager, but they did it outside the manager intentions. So okay, the guys that did the budget could done it correctly, but the problem was the manager that wanted to sell more. You understand my point?
Yeah, that was the example. That was the example. It was not so much so a problem with the budget itself, was a behavioral problem from the manager.
Okay, thank you.
And notice that the sales manager, he could even be responsible for the budgeted value of the sales. Okay, he could say, oh, let me budget for 5,000, and if I go above the 5,000, I receive a bonus, and so I know I can sell more. I will just put on the budget 5,000. Okay, that is why it's very important to work out the performance, how we evaluate the performance of managers. If they are linked to the budget, we need to be very careful so that the managers will not behave in this way, which is not correct. It's not ethical way of working, because they are damaging the performance of the company as a whole. If we think about this story, obviously it's just a make-up story. If we think about this, the sales manager receiving a bonus, but he's responsible for everything else going wrong, right? So, and maybe if the company saw, oh, the production manager, he was really poor, he had a really bad performance, but it was not his fault. You see? So it's very important that when we talk about the controllability principle, when we talk about when the company they set the way that they evaluate the performance of managers, is very important that we do it in a way that will not be unfair, okay, and will not lead to these kind of problems. Okay, so this is very important when companies are setting the rewarding mechanisms, the reward systems or the bonus, and evaluating performance.
Professor, I have a question.
So, what?
Yeah, you were saying that the manager of sales was culpable for everything, but for example, the direct materials, in normal conditions, when you use more direct materials, you buy more, so you could have a discount, for example. And the price increased, the price of direct materials increased. That
was higher than expected.
Yeah.
And let's imagine that if the purchases manager, the manager that purchases the materials, he knew beforehand that they would need more materials, he or she could negotiate the price of materials. They could search for more suppliers. But if they don't only know this information, or no, out of nothing, instantly there's more demand, we have to produce more last minute, they do not have the negotiating power to negotiate the price of the materials that they want to purchase. Okay, so if there was a coordination, if there was communication, they could have negotiated a better price for materials. And because it was last minute, just on this makeup story, if it was last minute, they didn't have this negotiating power and they ended up paying more. But it could also be for other reasons. The previous story that we tell from Marla, it could also happen, okay?
Yeah, but it smells like the manager of direct materials was not very good as well.
Yeah, we can also argue that. He paid more expensive for materials of poor quality.
Yeah.
Yeah, we can also argue that he did not do a good job. And we can also argue that maybe there was a problem in the materials because of the lockdown. They could not have access to the previous resources that were being imported from a different country, and they had to use a different material. That is why it was more expensive, and that is why were not as efficient in the usage of the materials. Could be, okay. Could be different reasons explaining these materials. More comments? No? So we see here a big difference between the expected profit and the actual loss. So how much is the difference? Between 43,500 and minus 26,400? $69,000. So this was unfavorable. They had a lower profit. The profit was lower, 69,900 than they expected. So this was quite unfavorable for the organization. Very good. So let's go back to the slides to see what we have next before going to the break. Okay, let's see what we have there before. So we compared the actual results with the budgeted results, and now we have here variance analysis. So variance analysis is the process of computing and analyzing the differences between the actual and the plan performance. So that's what we briefly did here. So we compared what was the actual loss with the expected profit. Now we will go deeper in this analysis. So why management wants to do this kind of analysis? To identify deviations from targets, and we identify deviations from sales revenues, identify deviations from materials, from labor, indirect salaries, and other overheads, which we need not talk about this, but there was also differences as we saw. We can even investigate the reasons for these differences. So we made these made up stories, okay, for possible reasons, because we don't know what actually happened. So we made these stories as a way to investigate possible reasons to justify the differences. And we can take corrective actions. So a corrective action that we could take in this example could be, for instance, the sales manager can only sell within the optimal production capacity. Okay, so where the company produces in an efficiently. So let's say that is 5,000 units. If they want to sell extra, they can sell extra, but maybe they have to sell more expensive. Okay, or they have to communicate with time, enough time so that other managers can purchase the materials and get enough labor at reasonable standard costs. Okay, so these could be some examples of corrective actions. Now, we will have two kinds of variances. We have favorable and unfavorable variances. So when we talk about profits or revenues, we want them to be higher than expected. So whenever actual profits or revenues are higher than expected, these are favorable. If they are lower, it's unfavorable. When we talk about costs, we want to have costs lower than what we expected. That is favorable. If actual costs are higher, that is unfavorable. Okay, it's very logical. Higher revenues, higher profits, that is good, that is favorable. Okay, higher costs is bad, unfavorable. Okay. So we have the three reasons that justify the variances between the budget and the actual results. So we saw here on this example, one of the reasons was the sales volume. So the sales volume, we expected 5,000 units. We actually had sales of 6,000 units. Due to this difference of sales volume, we would expect a higher profit, but that did not happen because of the other two reasons that we have there. Price. We sell more, but we sold at a lower price. And also price of materials and labor and other costs. We had higher costs with materials, higher costs with labor, higher costs with indirect salaries, and with other overheads. Okay. And we have another reason justifying the difference, which is the efficiency and the usage. And that we saw already that for direct materials, we used more direct materials than we should have needed according to the budget. If the budget was the efficient square meters of textile needed, If we used more, we were inefficient. If we used more labor than we should have, we were inefficient. And we saw this happen both with materials and with labor when we did the calculations. Okay, so the difference between budget and actual results comes from 3 reasons: volume, price, and efficiency. So remember this. There's 3 reasons justifying variances between budgeted and actual results. Now comes the question, and we already discussed this because we have very good questions. Yeah.
Could you, Frederick asked a question I was wondering on the chat.
Does justify in this context mean explain? Yeah, it means explain. Yeah, that explain the differences exactly. Okay, so when we hear 3 reasons explaining the variance, okay, that is what we mean by justify. Okay, was this the question? Any more questions? No. So now we come to the question if it is fair to compare this budget that we made for 5,000 units with the actual P&L which we did for 6,000 units. Is it fair to compare both directly?
Yes, but it is important to understand the reasons why are different.
Okay, so it's important to understand the reasons why they are different. But if you think about,
maybe it would be better to compare with a flexible budget.
Exactly. So you probably saw the next slide. So when we are comparing the budget, we did the budget for 5,000 units. And now we are having the actual P&L with that was for the level of activity of 6,000 units. So if we just look at direct materials or we just look at direct labor, we did already the proportional. We did the proportional here just in terms of materials and labor, how many hours, how many meters it should have been. And this is what we need to do. If we just compare the initial meters with the actual meters, it does not make sense because it's a different level of activity. Okay, and that is why we should adjust the budget. Okay, so that's what we have in the next slide. When we compare the actual budget and with the actual results with the budget, this can cause problems because there's a different level of activity, a different volume. And this can be misleading if you want to evaluate the performance of managers, okay? That is why we should prepare the flexible budget. So what is the flexible budget? Is a new budget. So we will make a new budget, assuming that we knew how much was the actual quantity, how much was the actual level of activity, 6,000. So we'll make a new budget. So a new budget, but instead of making the budget for 5,000 units, we will make the budget for 6,000 units. And then we can compare that with the actual results because both will be for the same level of activity. On this flexible budget, we will use the same assumptions as the budget in terms of standard prices and efficiency and usage, okay? So on the standard budget, we will use the standard selling price, £50. We will use the standard cost per hour of labor, the £10 per hour, the same cost per square meter of textile. So we will use the same standard costs and same efficiency. So we will assume same number of hours per unit and same number of meters per unit. exact same assumptions as the budget. Only difference is the level of activity. Instead of doing the budget for 6,000, is doing the budget assuming that we could predict, that we had predicted the 6,000 units level of activity. Okay, this will be useful so that we can compare the budget with the actual results. Okay, so we can better evaluate the performance of the managers, what went wrong, what should have happened, and what actually happened. Okay, and we will do this later after the break. Okay, so let's go for the break now, and in half an hour we will prepare the flexible budget. Okay, so I will stop recording and we will be back in half an hour. Any questions before you go to break?
Yeah, I have a question. Can I ask? I was doing the optional activities on weeks 2, and there was one exercise, or maybe more than one exercise, where we had some selling price and volume of costs with euros and not units. This means that, for example, the selling price of a product is 15 euros. It means that it's 15 euros per 1 unit.
I'm sorry. So you're talking about a problem on week 2, is that it?
Yeah, the optional activities in week 2.
Optional activities in week 2. Okay, with CVP analysis. Okay.
Yeah, we have some exercises. I think that more than one exercise where we had to calculate the break-even point with the selling price and the costs, the variable costs, and we had like variable costs equal to 10 euros, for example. It means that these 10 euros are 10 euros per unit.
Yeah, it should
or
be.
no?
Yeah, it should be per unit. Otherwise, they will tell if they will tell is total variable costs.
Okay. Thank you.
But if you're not sure and you want to show me the exercise, I can tell you.
No. I think that it's per unit. Just wanted to
if it's
to
10
ask
euros,
you.
10 euros, 15 euros looks like per unit.
Okay, because as you know, we have different formulas, so
Yes.
it was important to know. Thank you.
Okay, any more questions before we go? No? Very good. So we will see again in half an hour. Okay, let's go for the break. Okay, good afternoon. Let's go back to the second part of the class today. So we were here in this example, so in which we had the actual results for the company. So we did already, we had the budget that we did last week. We prepared the P&L with the actual results, and now they are asking us to prepare the flexible budget. Okay, so that's what we're going to do now. We're going to prepare the flexible budget. Are you guys there? Are you back from the break?
Yes.
Yeah, okay, perfect. Thank you. So let's prepare the flexible budget. So as I mentioned before, the flexible budget is exactly the same as the budget, same assumptions on standard prices, standard cost, and efficiency. Only thing that changes is the volume of activity. So we are going to prepare the flexible budget, and then they're asking us to compare with the actual results. So let me stop sharing, and we will be back here to the board. So let's do the flexible budget. So the flexible budget we do for the actual level of activity, which is 6,000 units. So if we calculate the sales revenues, the sales revenues will be for 6,000 units. And as we assume the same standard price is the 6,000 times 50 pounds per unit, okay? Assumptions of the budget, volume of activity of the actual 6,000. So when we did the budget, we expected to sell 5,000 units times 50 pounds per unit. And here we expect the same, we have the same expected price, 50 pounds, but the actual quantities, 6,000. 6,000 times 50 gives us 300,000. So this is what should have been the sales revenues, 300,000, okay? And they were actually 276,000, and that was because we sold at a lower price than what was expected. Then we have direct materials. Direct materials we will calculate for the actual volume. So we expect direct materials to be 3 meters per unit, 3 meters per unit, at a standard price of 4 pounds per meter times 6,000 units. So that would give us 72,000. 72,000. And for direct labor, we expected to spend 1.25 hours per unit at the standard cost of 10 pounds per unit times the 6,000 units, which would give us 75,000 pounds. Okay. In this sense, we would have an expected contribution margin of 153,000 pounds. So when we compare this to the original budget, this original budget, we call it the master budget or static budget, is the budget that we had from the beginning. When you compare the flexible with the static budget, we see an increase in everything proportional to the quantities. So we see a higher sales revenues because we expect higher, we had higher volume, we expect higher material cost and direct labor cost, okay? And also obviously higher contribution margin. This is all proportional, okay, to the level of activity. So when we compare the budget with the flexible, all of these, that is variable costs and revenues, all of this is proportional. We can, in Portuguese, we can do it regra três simples, okay? We can do the proportional to get the values. And then we have the fixed costs. The fixed costs, they are exactly the same as the budget, okay? So we will just copy what were the fixed costs. So as fixed costs, we had indirect salaries, budgeted indirect salaries 24,000, rent 6,000, depreciation 18,000, and other overheads of 36,000. This would give us a profit in the static, but in the flexible budget of 69,000. And now we see the difference between what the profit should have been and what was the actual loss is even higher than what we had before. Okay, and that was because we had so many things going wrong in terms of prices, in terms of efficiency. So like everything went wrong. Everything that could go wrong went wrong, almost, except for the rent and depreciation. Everything else was worse than what we expected. So we should have, for this level of activity, if what was budget in terms of standard costs and in terms of efficiency, that happened, we should have had a profit of 69,000, and we actually had a loss of 26,400. So here we have the comparison between what was the flexible budget and the actual results. Any questions? Now, remember, just before the break, I told you that we could justify, we could explain the difference between the actual results and the budgeted results with 3 reasons, okay? And that was level of activity, prices, and usage or efficiency. These were the 3 reasons that could justify or explain the variances between actual results and budgeted results. Now, when we compare actual results with the results from the flexible budget, do we also have these 3 reasons? Or what can justify the difference in results from the actual and the flexible budget?
Not the sales volume, maybe?
Not the sales volume, because the sales volume is the same, 6,000. So instead of having 3 reasons, we only have 2 reasons: prices and efficiency. Okay? So we can look at the prices and we will see, for instance, this is 50. The actual selling price was 46 pounds and the budget was 50. If we sold at a lower price than what we expected, that is bad, is unfavorable. When we look at direct materials, we also saw that where we had higher purchasing price per meter, and we also had higher quantities used. So there was the 2 effects there of efficiency, which was unfavorable, and of prices, which was also unfavorable. Someone was going to talk? Anyone wants to comment further on this? No? Very good. Any questions? There's no questions, so let's go back to the slides. Let me start sharing the slides again. So let's go back to the slides. So we did this, we compared the results, and now we have here the variances. So on the static or master budget, which is the original budget that we did in the beginning, is what we expected to happen. When we do the flexible budget, is what should have happened if we had the same efficiency as we expected and the same standard prices. The difference between the static or the original budget and the flexible budget is in terms of activity level, as we just mentioned. So in the original or static budget, we expected an activity level of 5,000 units, and now we actually had 6,000, and that is the level of activity that we use in the flexible budget. So the only difference between the profit that we had in the original budget of 43,500 to the 69,000 of the flexible budget, that difference is explained by the level of activity. So because we had a higher level of activity, the impact on profit was the difference between 69,000 and 43,500. Now we then have the actual results. The actual results is what actually happened, okay? And the difference between the flexible budget and the actual results, the difference is not from the level of activity, because the level of activity is corrected on the flexible budget, but then comes from the other two reasons: efficiency and prices. Okay, remember that the difference between the static budget and the actual results comes from three reasons: the level of activity, prices, and efficiency. Okay, now we want to analyze the variances, and we have here the steps that we use to analyze the variances. The first step we did already, which was to flex the budget, okay? And then we have to calculate the different variances, and I will give you later the formulas of the variances. So we will calculate the sales margin volume variance, the sales price variance, variable costs variance, and fixed cost variance. Then, after we have calculated all variances, we will analyze the significant variances. Because obviously for companies, they don't want to analyze everything, because that will take a lot of time and resources. They just want to analyze those that are significant, okay, those that had a big impact. There's little differences, like a few cents, a few euros, that is not worth the effort of spending time analyzing. So we'll only focus on those significant variances. And then we will reconcile the budget and the actual profit, okay? Reconciling the budget and the actual profit is to calculate where the differences come from item by item. We will investigate and explain the significant variances on this reconciliation, and then we will implement corrective actions if needed. Okay. So these are the types of variances that we have. We have sales variance, materials variance. So when we look at the P&L, basically we will have a variance for each item on the P&L. So we will have a variance for sales, and the variance for sales will be explained by selling price and also volume. We will have a variance in materials, which will be explained by the efficiency of materials usage and the price of materials. We will have the labor variance, the variable overheads variance, which we do not have here, variable overheads. And then we only have fixed overheads. So going on each variance in detail. So for sales variance, we will have sales margin volume variance. The sales margin volume variance is the impact on profit due to a different level of activity, okay? So on the sales margin volume variance, we will use not the selling price, but the contribution margin per unit. How do we calculate? We take the actual sales volume minus the budgeted sales volume, and we multiply by the budgeted unit contribution. That is why we can say it's the impact on profit, because we are not looking at selling price. We are looking at the contribution. Remember, the contribution is selling price minus variable costs, okay? And that is what we're focusing here on, the contribution. That is, and it's important that you know what the sales margin volume variance means, okay? It's the impact on profit, just because of a different level of activity. So you remember when we compare the budget, the static budget and the flexible budget, the only difference is the level of activity. So we can calculate with this formula the difference in profit between the static budget and the flexible budget. This formula will give us the value. We also have next the formula for sales price variance, which is the actual selling price minus the budgeted selling price times the sales volume, the actual sales volume. Then we have for materials, we have material price variance, which is the budgeted price per unit minus the actual price per unit multiplied by the actual material volume consumed, okay? And then we have the material usage variance, which is the budgeted materials volume consumed to produce actual output. So that is the proportional amount, so that is the quantity that we have in the flexible budget. Okay, to calculate the usage or efficiency variances is the quantity of materials from the flexible budget, the volume, the material volume consumed to produce the actual output, minus the actual material volume consumed times the budgeted price. Okay, this is how we calculate the usage variance. If we follow the formulas as they are here in the order that they are here in the slides, whenever it is a positive result, it's a favorable variance. If it is a negative result, it's an unfavorable variance. Okay, it's possible that, for instance, you are on the exam, you remember the formula more or less, you don't remember the order inside of the parentheses. But let's imagine calculating the materials price variance, you calculate in the wrong order, and then, but you know how to analyze. You know that, if the actual was higher, if the actual was higher than the budget, then that is bad, that is unfavorable, even if the result is positive. So it's always important that you keep your brains working to have this critical mind to analyze if it is favorable or unfavorable. For all variances, we have to identify if they are. We calculate the values with the formulas, and then we identify if it is favorable or unfavorable. Okay, so this is for materials. Then we have for labor, very similar as we had for materials. So the wage rate variance is the price variance of labor, is the budgeted wage rate per hour minus the actual wage rate per hour multiplied by the actual hours volume consumed. And the labor efficiency variance is the budgeted labor hours volume consumed to produce actual output. So this is the quantity of hours in the flexible budget minus the actual hours consumed times the budgeted wage rate. Then we have the fixed overheads. So the fixed overheads is just the budgeted fixed overheads minus the actual fixed overheads. And we have here for the variable overheads. So the first one, expenditure variance, is the same as price variance. So budgeted price per unit minus actual price per unit multiplied by the actual quantity. And the efficiency variance is the budgeted volume to produce actual output, so from flexible budget, minus the actual volume times the budgeted price per unit. Now we have here variances when we have more than one product. When we have more than one product, we have to take into account the mix, okay? So we can calculate the sales margin volume variance, which would be the actual quantities times the actual mix, minus the budgeted quantities times the budgeted mix. All of these multiplied by the budgeted contribution margin per unit. We have to do this for each product. So if we have product A and product B, we do actual quantities times actual mix of product A times budgeted quantities times budgeted mix of product A. And then we do the same for product B. And we have here the sales mix variance and the sales quantity variance. And then we have here possible causes for sales variance. So when we are looking at sales price variance, could be an expected increase in selling prices, could be inadequate definition of selling prices when we prepare the budget, could be an expected decrease in selling prices in order to increase the market demand. Okay, these are just some examples. We have here causes of the sales margin volume variance can be an expected decrease in market demand due to economic recession, can be an increase in market demand as a result of lower selling prices, can be a failure to meet market demand due to production problems. And we have here now causes of price variance, of usage variance. I will let you do these to read these at home. We have discussed when we were talking about some stories for this example, we already discussed some of these possible causes of variances. So for instance, when we have here a labor efficiency, could be because the machines were not in good condition, and that's why labor needed to take longer taking care of the machine to solve the problems, or the materials were of poor quality and they take longer to produce because they needed to handle the materials with more care. There was maybe poor supervision and therefore employees were not as efficient, or there was new equipment in the production process that the employees were not used to work with, and therefore they were not as efficient as before because there was not training on that equipment. Could be to changes in the production process, could be lack of training. So there's a lot of things that can justify variances. So only a few examples that we have here on the slides. Okay. So what we want to do now is to calculate the variances for the example. Okay. So I will stop sharing for a moment, and then we want to calculate the variances for our example here. So let me erase these, and you can open the slides there in PDF so that we can see the values to plug in the formula. So if you have there the slides with the formulas and with the values of the example, just have them ready so that we can calculate the relevant variances for this example, okay? Almost finished. So first variance we want to calculate is the sales variance. For sales variance, we have first the sales margin volume variance. The sales margin volume variance, the formula is, who has the formula there? Anyone has the formula? From the slides? Sales margin volume variance, actual sales volume minus the budgeted sales volume times the budgeted unit contribution. Okay? So let's calculate the variances. So sales margin volume variance. So the formula you have from the slides, actual sales volume, and actual sales volume was 6,000 units minus the budgeted sales volume, 5,000 units. So 6,000 minus 5,000 times the budget unit contribution. We don't know the budget unit contribution, but we can calculate the budget unit contribution. Now, the contribution margin per unit in the budget is the total contribution margin, which we had from the budgeted P&L, 127,500, divided by the number of units, 5,000 units. That would give us 25.5. Okay? So, times the budgeted unit contribution, that was 127,500 divided by 5,000 units. This is 25.5, and we get the sales margin volume variance of 25,500 pounds. Remember that we have to identify if it is favorable or unfavorable. Is this one favorable or unfavorable?
Favorable.
Favorable. Favorable because we sold, the actual quantities were higher than the expected, okay? So that is favorable. It's generally a good thing for organizations to sell more than what is expected. That is favorable, okay? Then we will calculate the sales price variance. Sales price variance is the actual selling price minus the budgeted selling price times the actual volume. Sales price variance is actual selling price. The actual selling price was £46 per unit, minus the budgeted selling price, which was £50 per unit, times the actual volume. The actual volume was 6,000 units. This would give us minus 24,000. Okay? I told you before, if we follow the formula, the result is negative, we already know is unfavorable. But we can easily see that it is unfavorable because the actual selling price is lower than the expected, the budgeted. And if we have an actual selling price that is lower, that is bad, okay? That is unfavorable. Any questions? No? So let's then calculate the variance for the material.
I have one question.
Yes.
If it's negative and you say that it's unfavorable, it's not like saying twice that is unfavorable. You understand what I'm saying?
Yeah, I understand what you're saying, but the result of the formula is a minus, okay? But that is because the way that we construct the formula, okay? But if we let's imagine we are talking with the CEO. You are the controller of the organization. You're talking to the CEO, and you say, no, we had a sales price variance of 24,000 negative or unfavorable.
Okay, my question is more, if in the exam you ask us for the sales price variance, we put minus 24,000 or we put or we put 24,000 unfavorable or minus. So you understand my question or not?
Yeah, I understand your question. You should write the result from the formula. What I'm saying, or what I said before, is that we don't, the way the order here.
Yes.
The order
I understand
here
it's just
is the result, but it's possible that in the exam you don't remember the order. If you don't remember the order and you have the wrong order, does not mean that you have it wrong. No, what we will look at, if you are having the individual components correct, if you're taking the actual price, if you're taking the budgeted price, and if you're taking the actual volume. And if you identify that it was unfavorable, okay, because we will look at the absolute value, okay, and identify if it is favorable or unfavorable. If you had the wrong order, but you said, okay, you got 24,000 and you identify it's unfavorable, you still have the full points, okay?
Okay. In the exam, it's not going to be multiple choice, right? We need to write the answer.
So in the exam, some questions will be multiple choice. Some questions you need to write the answers, okay?
Okay.
So we have both of them.
Okay.
More questions on this one? No, so let's go for the materials. So let's calculate the materials price variance. The materials price variance is equal to the budgeted price of materials per unit of materials, so the meters, minus the actual price per unit times the actual volume of materials. So the budgeted price per unit per meter, not unit of product, unit of material, per meter was, the budgeted was 4. And the actual, we don't know the actual, but we can calculate, or we calculated before, and we got 4.5. We got those 4.5, if you remember, was the 97,200 divided by the 21,600 meters. Okay, this gave us 4.5 as we calculated before. The amount in pounds times the total meters that were actually used. We will multiply this by the actual volume of materials, which was the 21,600. So this gives us minus 10,800 and is obviously negative because we had budgeted for £4 and we actually paid 4.5 pounds. So we paid more than what we expected. That is unfavorable. Let's now calculate the materials usage variance. And the material usage variance is the budgeted material volume for actual output. So it's the volume that we have in the flexible budget. So for materials, we expected to use 3 meters per unit. So that if we had actual volume 6,000 units times the 3 meters per unit, that is the budgeted volume consumed for the actual output, minus the actual volume of materials, which was the 21,000 meters and 600. So if we just multiply this, we have done this before, this was 18 meters that we expected to use. This we multiply by the budgeted price per meter, which is £4, gives us minus 14,400, and obviously is unfavorable. We used more meters than what we should have used if we were efficient. Any questions? So I see we have here a question from Tim on the chat. If I upload the solutions, no, the solutions that I'm doing on the board, I will not upload. Okay. So, but you can review. You can just copy or review or make a print screen as you wish. Now we will go for labor. We will calculate the labor rate variance, which is the price variance of labor. And we know that the labor rate variance is equal to the budgeted wage rate per hour, which is £10, minus the actual wage rate per hour, which was £14. All of these we get from the exercise. And we will multiply this by the actual hours consumed. The actual hours consumed, we know we have calculated, it was 7,800, but we can also do the calculations how we got there. So it was the amount of pounds, the total expenditure with labor, 109,200 divided by the £14 per hour, which gave us 7,800 hours. So this gives us minus 31,200. And we know that this is unfavorable, again, because we paid more expensive than what we expected. Okay, so that is unfavorable. Now we can calculate the wage rate efficiency, the efficiency variance, or the labor efficiency variance.
Can you just move the camera a little bit down, please?
Yeah. The efficiency variance is equal to the budgeted labor hours for the actual output, so the quantity that we have in the flexible budget, minus the actual labor hours consumed. So in the flexible budget, we expected to spend 1.25 hours per unit. Actual volume was 6,000 units. minus the actual hours, which we just calculated, 7,800. And we multiply this by the budget wage rate per unit, which was £10 per hour. This gave us a value of £3,000, minus £3,000. And we know this is unfavorable, so because this was 7,500.
Sorry, will all of this be on the exam? On the midterm?
It can go on the exam.
Okay. It seems like a lot of new stuff.
Yeah, it is to justify the variances. And notice this is a small example, right? It's just a small example, but there's a lot of things that will justify the difference in profits between the budget and the actual results. And that is what we are doing here. We are calculating all of the variances that justify or that explain this difference in profits. Okay. We will now only miss the fixed overheads variance or the fixed cost variance. So let's calculate that. Hope you can see. The fixed cost variance is we just take all of the budget costs minus all of the actual fixed costs. We just make the difference and we get the variance. Okay, so all of the fixed costs are those costs in the P&L below the contribution margin. Those are all of the fixed costs that we have. So for the budget, so is the budgeted fixed costs. Here we have.
Can you put the camera down again?
Okay, sorry.
Sure.
So that can you see now? Here?
Yes, thank you.
24,000 plus 6,000 plus 18,000 plus 36,000 minus the actual fixed costs, which were 28,000 plus 6,000 plus 18,000 plus 44,000. So if we make the difference of these two, the budget and the actual fixed costs, we get minus 12,000. And this is unfavorable because we had more fixed costs than what we expected. So when we look at all of these, we see that there's only one favorable variance, which is the sales margin volume variance. The only positive thing that happened was that we sold more quantities, okay? And just because we sold more quantities, we expected to have a profit, actual profit, higher than the budget in £25,500. But then there were so many wrong things going on in terms of price variance, usage variance. It's like everything else went wrong, and that just cancels the positive variance that we had from the sales margin volume variance. All of the others are unfavorable. Okay, so this is obviously an extreme example, which could have happened in organizations, can happen, okay, but this is an extreme example in which we see that a lot of things go wrong, and this is what justifies the difference in profit, okay, all of those variances that went wrong, okay. So sometimes the CEO could not understand how come that we sold more and we had a profit that is worse in 69,000. How come that happens? And here you could explain to the CEO, okay, so yes, we sold more quantities, but we sold them at a cheaper price. And just because we sold £4 cheaper than what we expected, that had an impact of £24,000. Okay, just because we sold £4 per unit cheaper. And then we look at the price of materials. Well, we purchased the materials 50 cents higher than what we expected. And that just that caused an impact on profits of £10,800. Okay. And the materials were of poor quality. And because the materials were of poor quality, we were less efficient in the usage of the materials. So we needed to use more quantities than what we expected. And that caused an impact on profit of £14,400. And we can explain this way all of the variances. Okay, so you see, this is an important task that organizations do to explain what happened. Okay, it's normal that things don't go according to what we expected, but we need to be able to explain what is causing the differences. Okay, and to explain that, we calculate the variances, which is what we just did here. Okay, any questions? Anyone wants to make any questions, any comments? No? So if you don't have any questions, we will go back to the slides. So let's go back to the slides. We have done this, the variances, the various variances. There's a lot of reasons that justify these differences in variances. So you can read all of these differences, all of these examples of causes later on. And just before we finish, and we have to have some time for questions, and this is our last class, okay? So we have finished the topics of the course, okay? So we have covered everything that was on the syllabus. We have covered topic 1, topic 2, topic 3, topic 4, last week with budgeting, today with variances. So we just finished this last part of the syllabus when we talked about the variances. You already have optional activity about variances there on Moodle with a quiz. And now what's else? You know, what's more on management accounting that we did not cover, because we were here, this is our last class. We were here for 1.5 months. Just 6 classes was very little. So you can imagine there's much more out there in terms of management accounting. We were just covering the basics, and it's a lot, you see. So you already mentioned, you know, that's a lot of variances that you're talking about. And it's true, but we just covered the very basics of management accounting. Before we did this, so we move forward. Just, I hope you have seen, I answered a question from student who was asking if there will be a formula sheet on the exam. I will not provide a formula sheet, and obviously only today there's a lot of formulas, but I will allow you to have a 1-page, okay, A4 page with formulas, and you can take this for the exam, okay? So on the exam, you just to practice for the exam, write down in 1 page all of your formulas since topic 1 up to today. You can write the formulas there in 1 page, and you can bring these formulas for the exam. And on the exam review, I will let the graders know, because if you're doing the exams online, you will need to have 2 cameras. 1 camera that is the camera from the laptop, that will show you face to face, and you need to have a camera placed somewhere on the sides, which can be your mobile phone. So you can have your mobile phone with a camera that will show the table where you're working, okay? And you can have there your calculator a basic calculator, and you can have there your formula sheet, 1 page A4 formulas. Okay, this is you can have on the exam. Any questions? Okay, so we have 1 page on 1 sheet. Yeah, can be one sheet, 2 pages. Okay, that's fine. Scratch paper, yes, you can have also scratch paper. Yeah, that's also good.
Will the exam be like a PDF file and then we need to write it on Word and deliver, like submit it, or is it like a Moodle quiz or something?
Yeah, I have not decided yet, but the most probable thing is that it's like a quiz on Moodle, similar structure as the optional homework 2, okay, in which you will have some questions will be multiple choice, so that's easy on Moodle, and other questions you will have space to write down, or you can write down on paper, take a picture and upload the picture on Moodle, okay, or write on an Excel and upload the Excel on Moodle or on Word, okay. So most probable will be this one, unless.
But if the camera of my cell phone is filming me, how can I take a picture and upload it?
Yeah, if you're doing when you are uploading, you will use the phone to take the picture, but that's fine, okay. When you do that, you have finished already, okay.
Okay. But we, for example, there's a question where I can upload a PDF. I can upload it just in the end, or in the end of that question?
In the end of that question.
Okay.
Okay. Or you can just put, for instance, there's several questions, you do everything in the same Word file or Excel file. You can just upload the one file at the end, okay? And you have different tabs. One tab for question 4, another tab for question 5 or something. Okay, Marla.
I'm not sure if this was answered yet or not, but I remember that you were saying if there would be a quiz on Moodle, you're thinking about that you could not go forth and back between the questions. Is that still a thing you consider? Or because I'm quite worried if I can't answer question 2 and I want to proceed with question 3, and then I know how to answer question 2, I can't go back. That would be kind of disappointing.
Yeah, the point there that you have to be careful, okay, is that it takes time, okay, for instance, when students want to first read all the exam, if you're reading the exam on paper, you just look around very quickly. But if you're on Moodle, and when, especially on exams, Moodle becomes slow. Then you move from page to page, and it just takes time, and it's time that you lost. And the exams online, you have limited time. So what I always warn students is that you do the questions as they appear, in order. And if you can go back, so I will allow you to go back, but to go back, you have to keep in mind that you're losing time. If you're going back and forth, that is time lost that you are not using for solving the actual questions, okay? So just keep this in mind, because this is a big constraint when we're doing exams online.
Yes, thank you. Perfect.
Okay, anyone else?
Yeah, so you said last week that you would say something about the exam this week. So I know that it's going to be multiple choice questions, but could you give us more information? Or
multiple choice questions. So you have an example exam online. Okay, we did the solution earlier in the class today. So you see there, that is the kind of structure of the exam. So there's multiple choice questions. Multiple choice can be theoretical and calculations, like the ones that you have every week on Moodle, on the optional activities, okay? And then there will be some questions which are problems, okay? Problems in which you have to do calculations, like the problems that we did on class, like the ones that we did just now, okay? When we actually need to do the calculations and show the formulas and the final results. And as we agreed, so there is very few people wanting to have an essay question. I think I will have a small essay question, but I will let you know about the structure of the exam next week, okay? If there is an essay question and how long the exam will be, I will let you know next week. I don't have that information yet about the duration of the exam, about how many questions are multiple choice, how many questions are problems. But the structure, you have the structure of the example exam there, and you are used to the kind of questions from the questions that we have on Moodle, the quizzes and the problems and the examples we do on class, okay? The duration, number of questions, I will let you know these details next week. Okay, more questions, comments about the exam?
There are still some questions in the chat, actually.
Oh, there are, okay. Let me see the chat. Can you have scratch paper? Yes, you can have scratch paper. Can you write the formula sheet in the computer or handwritten, as you prefer? Are we allowed to use Excel? Yes, you can use Excel. Okay, so you can use Excel and upload the Excel on Moodle. Okay, if we have these kind of questions, you can do that. Okay. About the structures, I think I answered to that question already. More questions?
Do you have any tips on which subject we should focus on the most?
Everything.
That was not the answer I was hoping for, but okay.
Okay, so look at the structure of look at the example exam. And you have like, it's a little bit of everything. And
okay, thank you.
I try to put a little bit of everything, okay?
Yeah, thank you.
Anything else?
Can you just, do you know how can we, I mean, if we can enter in the same Teams conversation with the same account from two different
Yes.
devices? So it allows for the same account to be there twice?
Yeah. So on Teams, so you received the Teams link. I think everyone received the Teams link yesterday. Yes.
Yes.
So you received the Teams link yesterday. So hopefully you have Teams installed on your laptop or on your computer and on your mobile phone with your university credentials. So hopefully you have this. So if you have your university email on your Teams on computer and on your Teams on mobile phone, you just click on the link on both devices and it will show both cameras.
Okay.
And what would they do with your phone? Because I don't really understand how that would work.
So there's an app do you have the app of Teams on your mobile phone?
No, I know how it works. I have Microsoft Teams on my phone, but I don't know what they would want to do with my phone. I mean, why use two cameras? What's the second camera for?
Okay. The second camera is to enforce that students are behaving properly on the exam, basically. So that is actually you. So the first camera on laptop shows like you see me, right? So you only see face and what's behind. So you cannot have like a white background. You have to see whatever your house is, okay? Wherever you are.
Okay.
You cannot have like a
guy dressed in green to match the background. Okay.
Okay, so you have to see to show what's behind. And then the other camera, which will be somewhere positioned on the side, on the backwards, will show your working area, will show your laptop and will show you where you work, okay? To show that it's actually you solving the exam, that you don't have a person next to you solving the exam for you. That is the purpose of having 2 cameras.
Oh, okay. Yeah,
Okay.
it's fine. It's just I thought it might be used to check what you do on your screen, but I mean, if my phone will
Yes,
be
also,
behind me,
yes,
but
it also shows the screen.
yeah, but at the same time, it would be from a distance. I'm not sure if you could even see what I would do on the screen. So if it's to check if people are in the same room, I understand the reasoning. But if it's to see the screen, I don't think it's I don't think it will really work. But we'll figure it out, I guess.
Yeah, I mean, if you go to email, if you go to Gmail, it looks totally different than an Excel that you have open, right?
Yeah,
so,
fair enough.
And we, as we are at home, we see, oh, he changed for something very different, or you put on the slides, and I can recognize that's the slides, that's not the exam. And when we identify such cases, and hope I have never identified that, luckily, because students have been behaving well, at least when we use this method last semester. What happens if we identify? We call the student. Okay, we call the student and we ask the student to show and to to try to understand what happened. Okay, and obviously students that are misbehaving or behaving in an unethical way, or breaking the code of conduct, they will be penalized. And that what happened last year. Last year, students in this course, there were students that shared answers, and that was I found out, and they failed the course. Okay, so hopefully no one will try to misbehave. Okay, because that was really bad. They failed the course, and it was I felt really bad, because these were students that was always sitting in the front row, always participating. Okay, and then they failed, and that was, and I could not understand why they did that, because they were very good students. If they had a grade on the course, they would have like 18 or something, because they were that good. But the continuous evaluation was only like 18, 19. Project, they had 19. Okay, and then they copy on the exam and they failed the course. That was really bad, really bad.
Thank you.
More questions? Marla, do you still want to ask something?
Oh no, sorry, I forgot to put my hand down.
Okay, so if there's no more questions on the exam, I will just show that there's a lot more on management accounting than what we covered in the course. So this was a basic course on management accounting. If you want to take the course on T4 that I'm teaching, the management control systems, we will talk in more advanced topics, things like strategic cost management, strategic performance management. We will talk about Kaizen costing, total quality costs. We'll be talking about balanced scorecard. Okay, so these are things that we explore further in the management control systems course. Hopefully, I was in conversations this week. We will have a guest in the management control systems course about process mining. Okay, so I'm arranging this. Last year, I was arranging a study trip. It ended up not happening because of COVID, and this year again we cannot have a study trip still because of COVID. Hopefully next year things will be better. But there's more things, okay? There's enterprise resource planning systems, and you can watch the videos about it. So what is ERP systems is like things you have heard about, like SAP, Oracle. They develop this software for organizations to help organizations do a lot of these management control activities in terms of purchasing of materials, payments to suppliers, clients. A lot of these is worked on enterprise resource planning systems. Sorry. I have then here articles in terms of controllers as business partners. And if you read magazines on this topic, so I think all of the links, if it's not all, the majority of the links that I have here are from Strategic Finance magazine, which is from IMA, the Institute of Management Accountants, and they always have some articles which reinforce the increased importance of controllers, management accountants in organizations as people that are taking decisions. So business partners are those that actually are important for the decision making. Then I also have there the role of the CFO in the strategic life cycle. Then I have articles there in terms of technological change, business analytics, big data, ethics, very important about ethics, and enterprise risk management, sustainability. All of these are topics that are emerging, that are very topical at the moment in relation to management accounting. But we didn't have time to cover this on the course, but you can read and learn more about this on the book and also on these articles that I share here on the slides. Then I just put here on the slides, this has a link to a magazine. So basically this slide is the salary guide for our area. Okay, so what are the skills? So if you're interested to have a career in this area, what are the skills that companies are looking for? What are the certifications that companies value? And what are the names of the posts if you want to search on LinkedIn, or if you want to search for a post in this area, what are the names of the job posts? So anything ranging from controller, financial analyst, accounting manager, internal auditor, senior accountant. So these are positions that are related with the topics we talked about. In terms of skills that companies want to hire, people with advanced Excel expertise, and I believe that most of you good in Excel. So I have seen that, I think it was it Gonzalo Duarte who once shared the Excel. So very quickly you solve the problem on Excel, and you even have courses that develop Excel skills. So very good. And then I'm sure you're all very good on Excel, and this is very important, okay? Knowledge on ERP systems. So we didn't have time to explore further ERP systems, but you can just watch the videos just for a quick background on what these are. Knowledge on cloud-based systems, experience with data analytics. So can have there other examples, strong communication skills. So for you to talk here online is already a development on your communication skills. So very good for those of you who are always there participating on the course. I'm really glad and proud that you always speak. Not all of you do, but you can still develop there that skill, okay? And that is important, as you see here. Then they ask for leadership abilities, adaptability and flexibility. Remember this when we watch on the first class, when we watch that video from SIMA, and they talk about adaptability and flexibility. So this is a skill that is important. And I'm pretty sure you're developing this skill, because as we had to move everything online and you had to adapt and be flexible to be online, learning online, and do group works online. So I'm also sure that you're developing this skill, and also the ability to collaborate with multiple departments. We also discussed this earlier on. And then we have there the certifications that they ask for. And as you see, one of the certifications is actually the Certified Management Accountant. And as I told you, we have this CMA scholarship. So if you would like to have a career in the finance department, okay, and you want to stand out from the crowd, so to say, if you want to go the extra mile, I would advise you to apply for the CMA scholarship. What you have to do to apply to the CMA scholarship? You just have to write me an email saying that you want to apply, you're very interested to have a career, you send me an email. Okay, so that is what you have to do, and then I will talk to you. Okay, and that's it, what I have for you. So remember, case study deadline 16th of March, next week. final exam 1 week from today. And we have now a few minutes if you want to ask questions about the case study.
Can I start?
Yes.
Okay, I just wonder if you can clarify the difference between unit, batch, product, and facility level.
Okay, so unit level activities are those that they are related with the unit. So if we have one more unit, I will have a little bit more cost. Okay, so are those activities that are related with the value, the cost will change based on the units. Okay, when we talk about batch level activities, are those activities for which the cost will change based on the batches. Remember, the batches is the lots. When we want, for instance, we want to produce a batch of, if we are a factory that produces cakes, we want to produce a batch of chocolate cakes. We produce vanilla cakes and chocolate cakes. So when we produce the batch of chocolate cakes, we have to adjust the machines for the chocolate cakes, okay? So the setting up of the machines is a batch level activity. We only do that and the cost will change for each new batch, not for each new cake that we produce, not for one unit. I only do it for the lot, okay? That is a batch related. Then a facility level. Has to do with the facilities, okay? Like can be cleaning the factory, can be costs with the rent of the factory, activities in terms of maintenance. So it has to do with the facility, okay? What was the other one? Product, okay? So for instance, when we come up with the designing of the product, or when we come up with the recipe of the cake, we only come up that for the product, the chocolate cake, okay, the product. So if we have two products, vanilla cake and chocolate cake, we only have that cost twice, okay? Once for vanilla cake and the other for the chocolate cake.
Can I do a more specific question?
Mm-hmm.
So, for example, we have the marketing team that works for the product specifically. But if you have a management team that manage this marketing team, is this product, batch, facility?
So what do you think? Or what other people in the room think? Is it related?
I think it still counts as product.
Sorry?
I think it still counts as product.
Products?
Yes, because it can't be unit or batch, because it doesn't depend on the production and the quantity, because they will have that marketing expense if it is just one product or if it's 1,000 products. But it isn't facility, because facility, I think it's more like fixed costs. So I think it's product costs, even if it's all of the products.
Anyone else wants to say something, give their opinions, if you share the same opinion or if you are of a different opinion? No? Okay, so what I'm going to do, so I received a group that sent me a question about this. Obviously, I cannot tell the answer, okay? But I will answer what I answered the other group. So I will post on Moodle on the group project, the forum on group project, the excerpts from the book, so the copy of the relevant bits of the book that explain better this part. Would that be good?
Yes, because I thought it could be facilitated just the way that it's related to administration. So we are not directly related to the production. We are just managing the team that is relating to the production. So I'm a little bit, I don't know if could be either way.
Okay, so I'm going to copy paste these little bits of the book and put there on Moodle. And I hope that will clarify. Okay.
Thank you.
More questions?
Sorry, no, go on.
Oh, thank you. I have a question about, I have two questions in different questions. The first one is on question 4. It asks about to discuss the steps that John, the management guy, should do to complete the project. And my question here is that it seems a little vague. So are we supposed to discuss the steps in an allocation process? So the 4 steps, and then discuss where John is and what he needs to do next? Or are we supposed to do more of a broad view of management accounting and discuss everything that he can do forever so that he can improve the accounting of the company? Which one? I feel like the question gives us a lot of room to decide where we want to go.
They ask to discuss the steps John should take to complete the project and then maintain the expense allocation process going forward. So based on data provided, what additional steps can be taken to improve the product expense allocation process at peak? So here basically is asking for you not only to focus on the short term, but also what is important to guarantee that in the long term this works. Okay, so we want them to have this allocation, this allocation system, and that this keeps working in the long term. So what should John do in the short term? Okay, and then what is important for this system, for this cost allocation system to function or to work, to keep working in the future?
Okay. And my other question is about question 7, I think. No,
so,
question. I don't know what question. It's the question where we need to adjust for the cost for the applications. So it basically says that from all the clients or potential clients, they make applications, and then from all of those, only a percentage goes forward and they issue the policy for those. And for the ones they don't, they say that we need to adjust the costs. And in our group, we came up with 2. I mean, we are a little divided on what to do. So some of us think that we should put that costs of the applications that didn't go forward with the policy, that we need to put them in the cost of goods sold from the other people, from the other clients, so that the price that is set for those policies can cover the costs of the policies that didn't go forward. And others think that it should be a separate cost. So the cost of goods sold, it's only for the clients that did the application and then issued the policy. And then we should have like other costs for the ones that did the application but not issued the policy. So the question is more, what is adjusting the costs?
Okay, so the costs, they need to show up. Okay, even if the costs that were incurred in these policies for which the clients didn't go forward, the company still incurred in those costs. So these costs need to be considered. We cannot just forget we incurred in these costs, right? So based on these, the question was,
should we put them in a different row? So selling price, then cost of goods sold for the ones that were issued, and then a contribution margin. And then on other costs, we have those costs that are also variable, but aren't really connected with the selling of the policies, or if we should include them in the cost of goods sold, even if they didn't result in a sale.
Okay, so we didn't talk about this, but when we do the comparison on this example, and when we compare it with a manufacturing company, it would be the case. Let's imagine a factory that produces cheese. When the factory is producing cheese, there will be cheese on any other product, and the same for services, as we will compare. What happens? The company has direct materials, okay, milk, and when they are producing cheese, there is a part of direct materials that of the milk that is needed as an ingredient, but then it will not all of the milk will translate in cheese. Okay, there is a loss. Okay, this concept of losses, which we explore more in a different course, not in this one, because we don't have time. So this concept of losses, we have two types of losses. We have normal losses. Normal losses is we know that for these many liters of milk, it gives these many cheeses, okay? This much cheese. And there is this loss that is normal in the process. There's nothing wrong in the process. We are not being inefficient, okay? We are being efficient, but it is normal that we have this loss. And it's the same here. We have this total number of applications, but it works as a loss, okay? It's normal that we are being efficient. It's just we cannot accomplish all of the applications to translate them into selling the final product. So it works as a loss. How do we treat losses? We have two types of losses. Normal losses, which are these ones. Normal losses, we incorporate the cost in the cost of goods sold. Okay. Abnormal losses is for when something goes wrong. Okay. The machine breaks down and we lost a lot of milk or a little bit of milk because the machine break down, or the employee made a mistake and ruined that batch. Abnormal losses are the result of inefficiencies or are the result of thief. Okay, someone came and stole the milk, for instance. So these abnormal losses are a cost of the period. Okay, normal losses, which everything is going well, efficient. We have these losses is normal. They are in the cost is incorporated in the cost of goods sold. If something went wrong, okay, that cost is a cost that goes directly to the P&L, is a period cost, not a product cost.
Okay, and we include normal losses in the cost of goods sold so that the price can be adjusted to cover those normal losses, right?
Exactly. So the cost of goods sold, so the cost of the products will include this part of loss that is normal. So when we price the products, if we use a markup pricing strategy, we will have into account this loss that is normal.
Okay. Okay. Thank you.
Okay. We had someone else?
Yes, I have a question. There's an exercise, well, regarding table 2, panel D, where they, like in the text, after they revise the allocation basis for some cost centers. For example, there are some cost centers that are said to only contribute to one product, but then the allocation basis is an allocation, well, it's, for example, life insurance policies or annuity policies, which is a general term. So our question is, if as the product, like it said, it only supports one product, is that number of policies only the number of that product's policies, or is it the total number of policies, like of all products? Because there's on the same table above, there are two items that they say, for example, direct to happy retirement or direct to life security, secure life, and those don't say it's direct to a product.
So let me see where you are.
On page 10.
Page 10, okay. So on table 2, which panel?
D.
Okay, panel D.
For example, yeah, sorry, in the top on marketing, for example, there's two items that only support one product. For example, one supports only happy retirement annuity, and the one below secure life, and the allocation says direct to happy retirement and direct to secure life. But lower, near the bottom of the page, on the IT, there are products that only, there are cost centers that only support one product. For example, the annuity projects and life insurance projects. And their allocation bases are annuity policies and life insurance policies, respectively. Are these, yeah, my question is if those allocation bases are, for example, the annuity policies of the happy retirement annuity in specific, or it's like the general altogether annuity, number of annuity policies?
Well, I believe you have to see what makes sense. This is one of those questions for which you have to make an assumption. Okay, so what makes more sense in this case? Okay, so for this kind of information, what makes more sense? Okay, and if you can even then discuss, okay, they are, for this information, for this cost, they're using this allocation base. It does not make sense because of this, and we will propose them to do this way. Okay, you can even do that kind of comment on the report.
Okay.
But it's an assumption that you have to take, okay?
Okay, thank you.
Professor, I have just one quick question. What do you mean by fixed within a range?
So
on table 6, for instance.
On table 6. So that has to do when we talk about the CVP analysis.
Yes.
We talk about the relevant range, remember? So on the relevant range is for that amount. So we have a range, minimum, maximum, for which we have fixed costs. Remember, for instance, we have fixed costs with depreciation. Depreciation is a fixed cost, but is a fixed cost for that relevant range. If we want to, and relevant range is normally short term, and what does it take into account? The number of machines that we currently have. If we want to produce much more, the machines that we have, they will not be enough. We will need to buy new machines. If we buy new machines, we have to, the depreciation will increase. So it will be fixed after the increase, okay? So the costs are fixed for the relevant range. Let me see, table 6, where is it on table? Okay, so
page 15.
Is fixed with a range within the range of 20% plus or above, plus or minus. So that is it. Okay, so for that range of production, these costs are that amount. If we go above or below the 20%, it means that, for instance, we have to buy new machines or hire new employees, okay? Or if it is below, we can sell machines, we can decrease the size of the offices, we can reduce the costs. Okay.
I just don't get what you mean by the current levels. Is that like the number of applications is the current level, and if you
is
go
the level
20%,
of activity, is the current level of activity. Okay. The current level. So the current levels here on the example that we did was the 6,000. We had 5,000 was budget, and the actual was 6,000 units.
Okay. Okay, thank you.
Okay. More questions?
Yeah, Professor, I had a question regarding exercise 3 and table 4.
Exercise, is this from the case study?
Yeah.
Okay.
Point 3. And I wanted to ask you if we have to explain how we would improve table 4 with respect to the risk management center.
Okay,
so imagine that this table 4 comes from the company we are talking about.
So
from sorry.
Table 4 shows the cost center of life insurance and the description of the activities. Based on this information, is the proposed basis for allocating expenses for these cost centers accurate? Why and how it could be improved?
My question was because here, page 7, they give like explanation on what is not correct and how the risk management center thinks that it would be better to improve. And so I'm asking if we can just start from that point and then develop something.
Yeah, you can definitely do that, yes.
Okay, thank you.
Okay. More questions. Anyone else? No? Okay, if there's no more questions, is there anyone going to ask a question?
No, just there is a question on the chat. I'm not sure if
it's a question on the chat. Can you explain a little bit more about information needed to make decisions based on ABC? So can you explain a little bit more about the information needed? I'm not sure I understand the question. Do you want to turn on your mic to ask the question, Frederick? So what do you mean? The information, which kind of decisions you're talking about? From question 6 of the case. Okay, let me look at question 6. Question 6, the team card information in table 5 and calculates a rate for each of the functions. Use the information in table 5 to calculate the cost rates of the functions. Is the information sufficient for decision making? Why or why not? Okay. So you are someone is asking, Danielle asking if you're supposed to involve external sources. Danielle, is this the same about the same question, or is it about a different question? Just in general. Okay, so let's go about this question 6. So this question 6, they are asking you to calculate the cost rates for the functions and if this information is sufficient for decision making. So you have to think about what kind of decisions they want to make. okay, to identify if that information is sufficient or not. Okay, so you have to explain based on what you say is the decisions that they have to make. So you have to identify, you do the calculations, and then you identify they want to make these decisions or this type of decisions. And for this type of decisions, this information is sufficient or no, or not, or we would need this extra sufficient to give extra support in taking this kind of decisions. Okay, so this is the kind of answer that you need to think about. Okay. And then Danielle is asking, are we supposed to involve external sources? When you talk about external sources, do you mean like a reference list, bibliography? Is that what you mean? Yeah, okay. Yeah, you can do that if you, for instance, if you want to have a good report and you want to explain and you want to go to the book, you want to go to the articles that I think I have some readings on ABC, on Moodle. You can use this and add your report, enrich your report with a bibliography, with a list of references. Okay, you can definitely do this. Okay, more questions. Anyone else with questions? Now, if you don't have any more questions, so if you want to ask questions about the case study, you can use the Moodle forum, okay, on the group project, the Moodle forum, use that to ask questions in relation to the case study. I have received a couple emails with questions, but it's always best if you use the forum because then everyone has the same information, okay? So that can help other groups as well. So this is our last class. Next time we will see each other, will be on the exam. So if you don't have any more questions, I will see you next week on the exam. And before the exam, I will let you know about a more detailed structure of the exam, like the number of questions and the duration. Okay? So there's no more questions. See you next week. Okay? Have a good weekend.
Professora, posso fazer agora umas perguntas em português, acho eu?
Sim, sim.
Ok. É que eu sou disléxico e tenho um bocado de dificuldade às vezes em fazer. Eu mandei-lhe e-mail. Se quiser eu posso ligar mais. Pronto. Então, as minhas perguntas são, primeiro, são aqui umas datas de exercícios que eu já estive a fazer as coisas e me surgiram. Primeiro, no problema 4.
Ok, deixa-me abrir o problema 4. Ou se tiveres aí já o PDF aberto e quiseres partilhar o ecrã, podes partilhar o ecrã.
Eu posso partilhar, assim é mais fácil, sim.
Então é mais fácil, sim.
Eu tenho de deixar, professor. Calma. Ok. Assim vou proibi-la de partilhar. Ok, deixa-me só ver se tem aqui alguma coisa comprometedora. Ok, continuando. Eu neste exercício eu percebi tudo, só tenho uma pergunta que é aqui, está a ver o meu ecrã?
Sim, sim.
Ok. A parte dos wages é suposto considerar fixo ou variável?
Portanto, estes wages por hora. Estes wages parece que são fixos. Tem overtime will be paid 1.5 times the regular wage and the fringe benefits will apply the total wages. Parece-me, portanto, porque ele temos ali em termos de quando é que ele diz informação? Ele não diz mais informação sobre...
Não é muito claro. Daí é que vem a minha pergunta. Não é muito claro, porque vê-se que as secretárias... Vê-se que são trabalhadores fixos.
Pois.
E como a pergunta depois é para fazer o income statement com a contribution margin, já depois não tinha a certeza como é que era suposto fazer.
Sim. Portanto, para os lawyers, que são 50 exatamente. Isto aqui é por dia, não é? Esta informação que nós temos.
Eles são pagos à hora.
Pois. E nós depois temos o número de dias. Temos o número de dias, o número de horas que eles trabalham e o número de dias. E depois tem a informação dos benefícios.
Sim, depois é o fringe benefits e o overtime.
Exatamente. Isso não varia de acordo com
A produção, sim.
A produção, que não é produção, mas não varia de acordo com a quantidade. A quantidade são as horas que nos dão.
Ok, então seria fixo.
Sim.
Então, neste caso, o único custo variável é aqui estes office supplies. Acho eu.
O custo variável, onde é que está os office supplies?
É o último linha.
Sim. É verdade. É.
Ok.
São custos fixos, sim.
Ok, então, mas ok, já percebi. E o último também, tudo bem. Agora, no 2 e no 3, eu não consegui, nunca cheguei ao resultado certo. Dão uns números muito estranhos, professor. Não sei se eu é que fiz mal, mas também isso...
Determino o total de, portanto, em euros e em número de clientes do break-even. Portanto, isso basicamente está a pedir o break-even, não é?
Exato. É só para fazer o break-even point. Mas se quiser esse exercício, eu posso mandar a minha resolução.
Pronto, então, mas vamos lá ver aqui o break-even point. O break-even point é o custos fixos, ok? Total dos custos fixos, a dividir, se formos fazer em unidades, a dividir pela margem de contribuição por unidade. Então, os custos fixos são os custos todos, menos os custos variáveis, não é? Os custos variáveis é só aquele 8.
Exato.
Não é? Portanto, todos os outros, dos lawyer, paralegal, secretary, do clerk, do advertising, do rent, do property taxes, utilities, insurance e equipment depreciation, tudo isto é custo fixo.
Sim.
Portanto, todos estes custos fixos vai para a fórmula. E depois, para calcular o contribution margin per unit, se calhar foi aqui que enganaste. Portanto, o contribution margin, nós calculamos, são os revenues dá de 5 milhões e 400.
Exato.
E os custos variáveis dá 144 mil.
Exato.
Portanto, há um contribution margin de 5 milhões 256 mil.
Sim.
Ok. Isto é o total. Por unidade, o contribution margin por unidade é que temos que somar as unidades dos dois produtos, por assim dizer. Portanto, que vai ser dos normal, portanto, o que eles fazem, o normal initial consultation e depois os settlements, ok?
E isso dá-me 300. As revenues por...
Não, mas não é revenues, é em termos de unidades.
Portanto, sim, as revenues por unidade dá-me 300, que é 60 mais 30% vezes 20% vezes 4 mil.
Não, mas então...
Ou então fiz mal. É assim, não é assim?
Não, então nós temos que ver em número de clientes. Ok? Nós queremos calcular por unidade por número de clientes.
Ok, então é os 4 milhões
então,
e 18 mil?
Não, então, o número de clientes dos Initial Consultation são 50 clientes por dia, né? Lá no primeiro parágrafo, no segundo parágrafo lá em cima, nós temos 50 new clients are expected each day. Portanto, são os 50 clientes por dia vezes os 360 dias, que dá 18 mil clientes.
Exato.
E, portanto, estes são os clientes dos Initial Consultation. E depois nós temos, depois, onde diz no primeiro pontozinho, que é no terceiro parágrafo, Barbosa estimates. No, Kevin estimates that 20% of new client consultations will result in favorable settlements or judgments. Ok? So, portanto, são 20% dos 18.000 que vão ser os clientes que vão ser estes settlements or judgments. Ok? Portanto, faz conta que são, apesar de ser 20% dos 18.000, é como se fosse um novo produto. E então somamos os dois, ok?
Sim.
Então vai ser os 18.000 mais os 20%, que é 3.600. Portanto, é 18.000 mais 3.600. E é assim que calculamos o contribution margin per unit. Dividimos o total do contribution margin pelos 18.000 mais 3.600.
Ok. Mas então, como é que fazemos? A minha pergunta é, então, os supplies também estão por unidade, estão por cliente, vão ser divididos por o quê? Por os 18.000 ou os 21.600 mil?
Não, aqui os variable costs nós calculamos só para os 18.000.
Ok. A minha pergunta é, como eu faria era, ok, se calhar eu estou a confundir isto e por isso é que estou a perguntar. Porque o que eu faria era, ok, já estou a perceber como é que fizeram. Ok.
Ok? Esta
Mas porquê que não
pergunta
se
não é
divide?
fácil, é difícil mesmo.
Mas então porquê que não se divide os supplies por esses clientes todos também, já agora? Porque assim não é contribution margin por... Nós queremos...
Porque vê lá, nesse último ponto, sim. But the cost of office supplies has been estimated to be 8 euros per new client consultation. Os settlements, eles já não são new clients, eles já são clients, não é?
Sim, mas a minha pergunta é então temos 21.600 clientes a que vendemos, certo?
Uhum.
E temos custos variáveis que estão na base dos 18.000. Está a perceber o que eu estou a dizer?
Pronto, isto funciona como se fosse...
A contribuição margem unitária vai ser 250 menos 18?
Pronto, aqui é aqui os 18.000, portanto, nós temos os 18.000 que é a base, ok? São os initial consultations, e nós sabemos que existe uma parte, e estes compram um produto. Temos uma parte destes clientes que vão comprar um outro produto, ok? Que são os settlements ou judgments. Para nós calcularmos o break-even point, uma vez que o break-even point nós estamos a ter em conta nas revenues, tanto faz ser revenues que vêm desde initial consultations, como as revenues que vão vir destes judgments, destes settlements, nós estamos a ter em conta os dois tipos de revenues. Nós, quando vamos calcular o break-even point, nós temos que ter em conta também, uma vez que a margem de contribuição é calculada para estes dois tipos de produtos, nós vamos somar estes dois clientes, ok?
Uhum. Ok, mas então, para chegar à margem de contribuição unitária, temos a margem de contribuição total, certo?
Uhum.
Que é os 2.4 menos os 144 mil.
Uhum.
E vai dar a margem de contribuição total.
Sim, 5.256.
Sim, e se dividimos essa margem de contribuição total, vamos dividir pelo quê?
Vamos dividir pelos 18.000 mais os 3.600.
E isso vai dar a margem de contribuição?
Por unidade.
Vai dar 242?
Portanto, deixa eu fazer a conta.
É porque eu tinha feito aqui uma coisa mal e não tinha essas coisas que não estava a confirmar. Dá 243.
Dá 243.
Então, os 8.000... Então quer dizer que não vamos... Os 144 mil também temos de dividir por 21.600. Percebe o que é que eu estou a dizer?
Sim, estou a perceber.
É que a minha dúvida vem daqui desta dinâmica?
Estou a perceber aqui a dúvida. Aqui é como eu estava a dizer, este exercício não é fácil e cria alguma confusão nos alunos, exatamente por causa que os clientes são os mesmos, não é? Mas como os mesmos clientes, à parte dos mesmos clientes, estes 20% que vão usar um outro serviço, não é? Estes settlements, apesar de serem os mesmos clientes, nós, quando formos calcular o break-even, nós temos que ter em conta também estes clientes do novo serviço.
Claro, claro. Mas é isso. Mas se a questão é, assim também não... assim também não é... Como é que eu ia te explicar isto? Assim também não está bem, ou está? Percebe o que eu estou a dizer? Assim como estamos a fazer, está bem?
Está bem.
Só por causa disto que eu lhe estou a dizer. Então como é que calculamos a margem de contribuição? É 250 menos 8 ou menos outra coisa?
Mas os 250 é que eu não estou a ver de onde é que eles vêm.
Desculpe, senhora. É os 5 milhões e 400 a dividir pelos 21.600.
Ok. Estavas a tentar calcular por unidade, logo pelos pontos. Pois não assim complica mais um bocadinho, não é? Aqui realmente fica mais fácil a lógica se pensar só a dividir o total pelo número de unidades.
Ok. E se dividimos depois o total dos custos vai dar o resultado que está aqui nos problemas. Ok. Tá bem. E depois se tiver mais alguma dúvida neste eu mando...
Podes mandar e-mail ou então pôr mesmo lá no fórum do Moodle, porque assim também pode ajudar outros.
Mas eu ainda tenho muito mais dúvidas, mas estas são mais rápidas. Esta era a pergunta mais difícil. Que são coisas, são pontinhos. Desculpe, estou aqui a mostrar as coisas de Erasmus. São pontinhos rápidos em perguntas, são coisas mais teóricas. Mas só para acabar o que eu tinha pensado era, nós, por cada, as revenues que nós vamos ter nestes 30%, depois dividir pelos novos clientes. Ou seja, está a perceber o que eu estou a dizer? Nos 20% dos novos clientes, dividir como se fosse tudo pelos novos clientes. Ok, mas não interessa, depois eu mando, é mais fácil assim.
Ok.
Depois, a segunda dúvida é no problema 5, na última de todas. Eu não percebi aqui uma coisa. Onde é que está a resolução? Desculpe lá. Ok, aqui. Porquê é que aqui neste último, porquê é que para a empresa não se devia fazer a transferência?
Ok, então queres pôr lá na pergunta?
Sim. Ui.
Portanto, nós estamos aqui assumindo que o Audio Division is selling all speakers it can produce to outside customers. Portanto, se eles conseguirem vender tudo para fora, pergunta para o áudio qual é que é o transfer price e para o Wi-Fi qual é que é o transfer price. Ok, podes colocar lá nas soluções.
Sim. Tipo, o preço mínimo para a selling division é 60 euros e para a buying a máxima é 57. Eles não vão aceitar, eles não vão chegar a um preço, mas para a empresa total é melhor não...
Porque para a empresa como um todo, ela ganha mais se vender externamente, né? E se comprar externamente.
Ok. Mas se o preço...
Para ser melhor para a empresa como um todo, eles tinham que negociar um preço que, por exemplo, se para vender externamente eles tivessem um custo de transporte e agora já não vão ter esse custo de transporte para se venderem internamente. Então, a empresa como um todo, ela vai poupar o custo de transporte, então eles podem conseguir negociar e pode ser bom para a empresa como um todo. Mas neste caso não é. Não é
Ok,
neste
ok. É porque se eles comprassem fora iam perder uma margem de contribuição de
Iam per-
18. Ok, ok. Já estou a perceber, ok. Próxima pergunta. Esta aqui foi rápida. Agora são mais rápidas, não se preocupe. Uh, é porque eu já estive a fazer isto tudo e fiquei com
Boa.
umas perguntas. Agora, eu já não me lembro onde é que era este. Quiz 2. O que é o quiz 2? Deve ser este. Deixa lá ver. Review. Ok. É nesta pergunta. 4.
Indirect product cost.
Ok. A minha dúvida é: product cost é aquele produto, é um custo que vai direto, vai valorizar o inventário, certo?
Então, é um custo do produto, né?
Exato.
Custo indireto do produto.
Ok. O president salary é um product cost? Não é um period cost?
Which of ok, essa é uma boa pergunta, hein? É uma boa pergunta. Exatamente, bom raciocínio. Aqui podíamos argumentar isso. Podíamos sim.
É que essa foi a minha questão. Eu fiquei confuso com todas as opções. E esta aqui, a Property Taxes on Facility, Plant Facilities, eu sei que não era, mas President Salary é administrative.
Então, o que nós vamos, o que nós podemos aqui, which of the following costs is a indirect product cost? Se nós pensarmos no produto A e no produto B, o property taxes na plant facilities é indireto, é indirect.
Exato.
Okay? É um custo indireto porque nós não sabemos quanto é que é do produto A e do produto B. Ok? Aqui, como fala product cost, pode ser production cost. Ok? Tipo,
Sim, mas
só produzem um produto.
Mesmo property taxes é um period cost, vai logo ao income statement. Os taxes estão sempre no income statement. Mas
este aqui tem a ver com a fábrica. Ok? Como são impostos da fábrica, ok? Então, é um manufacturing. Então,
sim,
podemos alocar como manufacturing cost.
Sim, mas os taxes vão para o manufacturing cost também?
Dos manufacturing overheads são todos os custos relacionados com o processo de produção. Se nós não produzirmos, não vamos ter fábrica, logo não vamos pagar o imposto da fábrica.
Ok, mas os taxes podem ser
Mas
product costs ou são sempre period costs?
depende dos taxes.
Ok. Então aqui a resposta seria...
Estes são específicos property taxes, é tipo o IMI da fábrica.
Sim.
Okay? Mas os taxes relacionados com outras coisas, por exemplo, o Social Security, podemos considerar o Social Security como um tax.
Sim.
E o Social Security dos empregados que trabalham na fábrica são manufacturing cost. Okay?
Exato. Sim, tem razão. Mas aqui então a pergunta era o quê? É que eu fiquei mesmo confuso com isto, eu não achei mesmo que era o present salary, porque é um period cost, não é? É indireto, sim, mas é um period cost.
Normalmente vai ser um administrative cost, que é um period cost, exatamente.
Ok, então aqui...
Aí era um bocadinho traiçoeiro.
Ok, então aqui o que é que punhamos nesta pergunta?
Tínhamos que mudar a pergunta. Tínhamos que mudar ali a pergunta.
Ok. Porque... Ok. Então, próxima pergunta. Tem a ver com os relevant costs. É que eu tenho aqui apontado. Relevant costs. Quiz relevant costs. Como é que está?
É aí.
Classe 3. Isto aqui é mesmo na aula em si. Tem aqui nestes exercícios. Ok. tem a ver com este slide aqui.
Ok. Portanto, o relevant cost to direct labor. Portanto, se a empresa trabalhar a full capacity...
Sim. Pronto, eu posso dizer a minha dúvida, que é a hourly rate já íamos pagar de qualquer das formas. Por isso, o meu instinto seria que ia ser só o opportunity cost.
Aqui, porque, portanto, se nós realmente pagamos o hourly rate, mas se nós vamos produzir este produto ou esta special order e o trabalhador vai deixar de fazer o outro produto, o custo já não vai para o outro produto, tem que ir para este.
Ok,
Ok?
estou a perceber. Porque temos a contabilizar esse custo quando estivermos a ver, a decidir entre outras alternativas. Ok. E ainda nestes slides, slide 39, este aqui consegui apontar. Ok. O que se diz aqui é, estamos no 39, certo?
Sim.
O objetivo de transfer pricing, better goal, eu fiquei aqui um bocado confuso com a parte do better goal congruence.
Ok. Portanto...
Eu vou lhe dizer porquê. Porque ao deixar as empresas, as pessoas estarem ali, os managers começarem a negociar, eles vão tentar o melhor para eles e não para a empresa. Porque é como aquele exemplo que tínhamos visto, que se como a selling division estava com full capacity, ia pedir um preço demasiado alto e a buying division ia ter de comprar fora, mas isso era mau para a empresa. Isso é mau a nível de goal congruence. Está a perceber o que é que estou a dizer? É que eu sou muito mau a explicar-me.
Não, percebi. Eu percebi. Portanto, mas aqui isso podemos ver numa perspectiva que, ok, cada divisão tem o seu objetivo, não é? Portanto, nós temos aqui, quando falo do autonomy, quando falo do performance evaluation, do motivation, cada divisão tem o seu objetivo. Por exemplo, a Navigator produz a pasta de papel e depois a pasta de papel eles vendem para fora, né, para o estrangeiro, e vendem e usam internamente e fazem resmas de papel que a gente compra no dia a dia. Portanto, temos que pensar a divisão que faz a pasta de papel, ok, eles querem maximizar a sua atividade, não é? Querem maximizar a sua atividade. E os outros que produzem as resmas de papel, eles também querem maximizar a sua atividade. Temos que pensar na empresa como um todo. Qual é que é o objetivo da empresa como um todo? E ver se estão... obviamente, isto é o trabalho que o CEO faz, quando o CEO quando o CEO está a preparar a estratégia, e aí vamos falar